Good evening, ladies and gentlemen. Welcome to the ET Now Market Summit 2026, co-powered by PhonePe. We will begin the proceedings now. Please welcome your hosts for the evening, Shibani Gharat, News Editor, ET Now, and Jude Saneth, South Bureau Head, ET Now.
Hello and a warm welcome, good evening and a very warm welcome to ET Now Market Summit 2026 co-powered by PhonePe, Mutual Fund Partner, HSBC Mutual Fund Associate Partner, LIC of India, Transit Media Partner on TV and Outreach Partner, Dalal Street Investment Journal. Now 17 years ago, ET Now set to put out India's viewer on a path of progress and prosperity. Rise with India is our commitment and our belief in where this nation is headed, Jude.
Absolutely, and that brings us to where we are today, Shibani. In fact, we meet against the backdrop of a real test. Market turbulence, geopolitical tensions, crude price shocks, FII outflows, and a shifting regulatory landscape. The job of this summit is rather simple. Cut through all that noise and hand investors clarity, confidence, and a structured plan really for the road ahead.
Absolutely. So over the next few hours, this stage belongs to India's finest leading economists, master fund managers and market strategists all in one room. No scripts, no spin, just bold ideas, honest conversations about where your money goes next. And now, I would like to invite Aisha Faridi, Executive Editor, ET Now and ET Now Swadesh, to take the proceedings forward. Aisha, over to you.
Well, thank you, Shibani and Jude. Ladies and gentlemen, firstly, thank you all of you for making it to this very special ET Now Market Summit today. And as we have it, ET Now has turned 17. Can you believe it? And to today celebrate this very, very special day with us, I must add that, in a world where we talk about equity markets, moving on sentiment and noise, our chief guest today, ladies and gentlemen, believes that the most powerful force in finance is something far more fundamental. He says that it's trust, actually. And a process-driven administrator, as he is, he's built his reputation not on headlines, but on outcomes. He has been the quiet architect behind some of India's most consequential transactions. The privatization of Air India, a huge round of applause. The largest IPO that Indian history has had so far, LIC, a huge round of applause once again. And now, as the chairman of SEBI, he brings to the regulatory table the same steady hand and the same North Star. And you know what his mantras are? Trust, transparency, technology, and trademark. A consensus builder that he is by instinct and a systems thinker by design, he does not merely regulate markets, he shapes the culture of accountability with them. Ladies and gentlemen, please join me in welcoming the chairman of the Securities and Exchange Board of India, Shri Tuhin Kanta Pandey. A huge round of applause, please. The chief guest of honor today. And along with him, I would also like to invite Ashish Sehgal, CEO, Times Television Network and Chief Growth Officer, Times Media and Entertainment, to welcome our chief guest with a token of appreciation. A huge round of applause, please, ladies and gentlemen. May I also request Shri Pandey and Ashish to next up light the ceremonial lamp, signifying an auspicious beginning of the ET Now Market Summit 2026. And what better an occasion, I must say, right? Look at the markets today. That 2% move on the index alone, it couldn't have come at a better time, this particular summit. Well, thank you, Ashish, for your time today. Ladies and gentlemen, to set the context now for the ET Now Market Summit 2026, on the sidelines of ET Now's 17th anniversary, I'd now like to request our chief guest, Shri Tuhin Kanta Pandey, now to deliver the keynote address on navigating volatility in a new world order. I'm sure all of you are very flummoxed by all the headlines that we see every morning and all the Truth Social posts that we are bound to track, what's happening with crude, what's happening with gold, all of it. And maybe Sir will make some sense to this madness for us. Sir, please.
Distinguished guests, leaders from the market ecosystem, investors, industry participants, members of the media, ladies and gentlemen, good evening. I'm delighted to be here at the ET Now Market Summit. The theme before us is apt: navigating volatility in a new world order. We meet at a time when global markets are being tested by geopolitical tension, energy shocks, supply chain fragmentation, and AI-centric technological disruptions. In such a world, volatility cannot be wished away. It must be managed. The real test is whether our markets can absorb shocks, protect investors, and continue to support capital formation. Indian capital market has been facing one challenge after another over the last couple of years. Tariffs, price and supply shocks on oil and gas due to war in West Asia, AI disruptions, and FPI outflows. Yet, capital formation has continued. In April and May of this financial year, FY27, our market has helped raise more than 1.5 lakh crore, around 70,000 crore through equity, and around 86,000 crore through corporate bonds. IPO activity has remained relatively subdued during these 2 months, but the IPO pipeline of around 1.5 lakh crore remains robust for the coming months. SIP assets now account for nearly 20%, 21% of mutual fund industry assets as at end of May 2026. The SIP stoppage ratio also declined to 95% after remaining above 100% for 2 consecutive months. In simple terms, the new SIP registrations again exceeded SIPs that were stopped or completed. This also is an encouraging signal. Even in volatile markets, investors continue to follow a long-term investment approach. India will continue to welcome global capital. At the same time, our market now has stronger domestic base, which provides support even when external sentiment may have weakened. Markets may be volatile, but they must not be disorderly. Volatility must not damage investor trust. At SEBI, our approach has been one of optimum regulation. regulation which is effective but not excessive, regulation which reduces risk while allowing innovation. Strong market infrastructure is central to this approach. The building blocks are already in place. T+1 settlement cycle, IPO listing timeline of T+3, faster rights issues, direct payout, blocking of funds, and digital processes have improved safety and efficiency. Our market infrastructure institutions are stress tested through live disaster recovery drills, while our clearing corporations are interoperable. Regular stress testing ensures that mutual funds are equipped to manage any redemption pressures. Governance of MIIs remains our biggest priorities. Consistent with regulatory changes, MIIs have proceeded well on strengthening their boards with appointments of new ED level positions at verticals 1 and 2. In market infrastructure, preparedness is resilience. The next phase will be guided by the recommendations of the working group constituted to draw the 5-year and 10-year roadmap for MIIs. Technology will be a major pillar of this roadmap. MIIs must invest ahead of scale, not after stress. Trading, clearing, settlement, surveillance, cyber resilience, and disaster recovery must be upgraded continuously. The use of secure and safe AI with human in the loop, we call it HITL, approach will be an important component of this roadmap. We have improved access for markets, foreign investors, through digitized onboarding and Swagat framework for trusted foreign investors, and we intend to do more: faster registration, digital signature-based submission of documents. Net settlement will reduce funding cost and forest risk for FPIs. Introduction of the closing auction session and revised block deal window will facilitate large institutional transactions and reduce tracking error. We have taken calibrated measures to improve and strengthen the derivatives segment, including better risk management, monitoring, and surveillance. SEBI will continue to act as an enabler. We will support innovation, reduce friction, and deepen markets. But enablement cannot come at the cost of market integrity or investor protection. A resilient market needs fair rules, honest conduct, and credible deterrence. We will act decisively where we see egregious violations, manipulation, fraud, misuse of investor funds, or attempts to mislead the market. Appropriate enforcement is not contrary to market development. It's a necessary condition for market development as well as investor protection. We are working to improve our capacity, both human and technological, for improved surveillance and timely enforcement. The way ahead has 3 tracks. The first track is lower friction. Ease of doing business is not merely an administrative objective. Clearer processes move capital faster. Sharper disclosures reduce uncertainty. Easier access improves confidence. The LODR framework is currently under review to make it more responsive to emerging governance and disclosure requirements. We will also review the delisting framework further. A well-developed capital market must provide fair entry and fair exit. Independent directors play a crucial role in corporate governance. Their role is not limited to asking difficult questions on governance. They must contribute in board discussions how best to address emerging challenges such as AI, cybersecurity, ESG, R&D, and rapid technological change. At the same time, they must protect minority shareholders' interests and support long-term value creation. SEBI will therefore work with all stakeholders to build a robust, scalable network for capacity building of independent directors. The regulations related to municipal debt and portfolio management services are also being reviewed. The objective is to address practical issues faced by stakeholders and ensure that these frameworks continue to support market development. For foreign investors, as I said before, we'll continue to ease access through simplifying KYC and a risk-based review of disclosure requirements. We will work with other regulators to ease KYC process for NRIs. Our efforts will be to provide clarity that global capital seeks, especially in uncertain times. The second track is deeper markets. Deepening the cash market is a priority. The securities lending and borrowing and short selling frameworks are being comprehensively reviewed to facilitate interlinkage between the cash and derivatives market and enhance liquidity. Derivative markets also requires more development. Development of longer-term futures and options contracts in equity derivatives market will be an important part of deepening the capital markets. In commodity derivatives, our proposals on extending early pay-in benefit to options contracts, phased shift from cash settlement to physical settlement in select agricultural commodity contracts, and review of position limits are aimed at deepening participation and strengthening risk management. Electricity derivative contracts are being traded on our exchanges now. Longer term and newer forms of contracts in this space will be required going forward. We will also be looking to bring in, along with RBI, derivatives on bond indices. We are reviewing the innovators' growth platform so that strategic sectors like AI, semiconductors, clean energy, biotech, advanced materials, defense tech can access our markets better for long-term capital. In debt markets, we are working on the market-making framework for corporate bonds, deepening of the municipal bond market, and tokenization of corporate bonds. REITs and InvITs will remain important for asset monetization and recycling of capital into new infrastructure. We are looking to align their listing timelines with equity so that investor capital is deployed faster. In the AIF space, the accredited investor framework is gaining momentum. The number of accredited investors has increased substantially over the last 1 year. We are exploring ways to leverage digital public infrastructure to further streamline the accreditation process. Let me come to the third track, which is track of responsible growth. In volatile times, an informed investor is less likely to panic, less likely to be misled, and more likely to stay invested with discipline. Project Jagruk is SEBI's effort to make investor education a unified national mission. The focus will be on responsible investing. The campaign will combine physical and digital outreach, use Indian languages, and bring together SEBI, MIIs, AMFI, NISM, and other market partners. AI will be an important part of our regulatory agenda. AI can improve surveillance, risk assessment, fraud detection, and investor servicing. But it also brings risks related to opacity, bias, data protection, cybersecurity, and accountability. SEBI will issue detailed guidelines on the responsible use of AI in capital markets. IOSCO's AI supervisory toolkit will also be suitably integrated into SEBI's AI strategy for regulated entities. Markets will continue to be tested. Our response must be to build markets that are deep, transparent, well-governed, and trusted. For investors, my message is simple. Invest with a plan, understand your risk, diversify, and stay disciplined. SEBI's commitment is clear. We will keep our markets prepared for shocks, open to innovation, and anchored in trust. Growth must rest on fair conduct, strong institutions, and resilient infrastructure. India has the foundations, the investors, and the institutions. Our collective task is to build on them with discipline, integrity, and confidence. Thank you. Jai Hind.
Right, thank you so much. Thank you, Mr. Pandey, for setting the tone for the evening.
Now, foreign institutional investors have pulled out billions this year, and yet our markets have barely flinched. Now, the reason is the domestic investor steadily buying every dip. And while FIIs have sold equity to the extent of 3.4 lakh crore rupees this year so far, that has been met by strong DII buying of 4.32 lakh crore.
And Jude, that shift has rewritten how India absorbs global shocks. But every cushion has a limit, and this session asks where it lies. The resilience of DIIs in offsetting FII outflows. To understand this session, I'd like to invite back on stage Aisha Faridi, and she will be in conversation with Dinesh Pant, Managing Director of LIC. Aisha, take it over. A huge round of applause, ladies and gentlemen. Let's welcome Dinesh Pant along with Aisha.
Good afternoon, ladies and gentlemen. Once again, today I have with me Mr. Dinesh Pant, MD at LIC. So it's already on. To talk about the resilience of DIIs in offsetting FII outflows. Now, over the last whole year, we've heard so much talk about the FII exodus that has happened in markets. But if there is one DII who's like rock solid and backing this market, and that is LIC, sir. So I want to ask you, every time global markets have this, curveball thrown at us, every time there is FII outflows happening, every time when you wake up in the morning and track a certain gentleman's tweets, truthful as they may be, but LIC has been the wall that has backed the market and continues to hold it each time. What is the strategy or the thought process when you have so much going on in the world?
Well, thank you. Yeah. See, at LIC, sometimes we believe it's a God-blessed organization getting the, blessings of more than 20, crore policyholders, which we have. And this organization has built itself for last, almost now 70th year. This is our 7th decade when we are there. And the basic purpose of the setting of the organization and why it has been successful, you just mentioned about the hugely successful IPO also, has been our ability to create trust in people. So the basic underlying of LIC as an organization, insurance industry for that matter, long-term businesses, to build that trust. And it is a great, sort of satisfaction that at times when the contribution from long-term investor like life insurance is looked at, and in these testing situations, the way insurance industry and for that matter mutual fund industry has been able to come to the fore and be able to not only mitigate the impact of these FEI flows, but actually contribute and show the resilience of the economy is something which has not just happened by chance, but it has been, as we are listening to Mr. Pandey just now, it has happened because of the consistent effort of the policymakers, the regulators, and these big institutions, banks and insurance companies and mutual funds, that they have been able to contribute to the way in which that has been done.
But I have to ask you this, and allow me to ask you this, even if you don't like it. Is it the size of the flows that you sit on which force you to become the stabilizer in the market when there is so much going on a daily basis?
Oh, that helps. But again, I would like to take the credit to the Indian society. This cash flows which have been coming have just not happened on their own. It has happened because the organization, for that matter, has continued to deliver to the expectations. It's not that every time the situation of cash flows is always very good. It cannot be taken for granted. We have seen the times in year 2020 when COVID broke out, and we could see within 15 days markets crashed by 35%. And it was for the only one situation when we had fair value losses also. So over a period of time, apart from the fact that we are under the continuous glare of media and everybody, we have remained very consistent and focused on ensuring that whatever expectation, what we call as policyholders' reasonable expectation, or these expectations which are there from the financial sector itself or the policymaker, we stick to the those principles of good governance and ensuring that while we remain prudent, we remain active and alert in the market. So it has happened because of that thing. Cash flows do really happen and help. And good thing is that, as you rightly mentioned, these cash flows which have been available to us. For example, even if I would just give an example, the investment, the quantum investment that were done in the last year, almost 6.5 lakh crores or so. So that really helps us decide the right type of asset allocation, be able to, get the benefit out of that bulk, the size that we have. But it's a huge responsibility on the other side, because if it goes into the downside, it can become a big issue. Good and great thing is that our investment teams and the boards of the corporation, the corporate governance teams have been able to ensure that it has been an upward journey all along.
So if I were to ask you all through last year when everyone's cribbing about how much their individual portfolios have gone down, how much has LIC invested in the markets? And is there a target for the second half of the year now?
I would not be able to reveal the numbers, right? But what I can only say is that last year was phenomenally good for us, right? After some, downside on the year before, we had a very good year. In fact, people who have seen the quarter 4 results have seen in every parameter, and the asset under management is almost touching now 60 lakh crores, almost touching, right? From the public disclosed figures only I'm talking about. And the incremental investments have been above 5 lakh crores and have gone beyond 6 lakh crores. We expect them to keep on continuing to grow at 8 to 10% every year. So that is the amount of contribution that will continue to make in this market. And as an indication to it, almost of the aim is that 25 to 30% of the investments get invested into equity markets. In fact, our equity portfolio is almost around 20% of the total balance sheet. So we are looking, but we want to be present. It's not only about sticking to equity market, but we have to ensure prudence that safety is also ensured, and return of money and return of money both are ensured. So that's the bottom line for us.
Absolutely. But you just talked about your AUM size, 60,000 crore rupees.
60 lakh.
Yes. When you're deploying at that scale, I mean, in this market, is there a conscious sectoral call that you want to take? There's so much volatility. A lot of large, heavyweight sectors are marred by all sorts of question marks on them. Within large cap sectors also, there's so much of polarization. One stock is doing so well, the other one is a rank underperformer. How do you invest? I mean, is there some, investment theme or analysis or rationale that you go by when you do sector deployment in equities?
See, to the credit of the organization and to the credit of the regulators, I would say, the investment guidelines or investment regulations are fairly, specified. For example, 25% has to be invested in government securities. You can go another 25% towards, state government securities. And then there is an infrastructure requirement of 15%. So there is all sort of, but it still gives you large, bandwidth to choose from. And again, the investments are not on a very universal basis, because insurance companies run different type of funds. Like we have got participating funds where the benefits are semi-guaranteed and half of it is like, discretionary benefits. And since LIC has been having large pool of these participating policies, as against many other companies where the non-participating products, guaranteed products are there, where the equity participation is a bit risky. So because we have been having a large portfolio of participating policies, and discretionary element of, returns is also very critical there, we have been able to take exposure into the market to a great extent, the market value being even touching around 27-28% of that thing. So that has really been very helpful, but it comes with a lot of responsibility, because, the number of stocks runs in hundreds and hundreds. Managing them, monitoring them, pruning them, adding to them is a huge exercise. But the good thing is there are well-laid principles, well-laid investment policies, well-laid system SOPs there. There is a monthly review, there is a quarterly review, there is a as need on basis review. So all those activities ensure that to the best of our abilities we are able to do what we want to do.
But tell me, when you see the markets go down, when you see so much global volatility, during March lows, what was going on in your mind when you were investing in the market at that time?
See, one thing is this is a little different from individual investor, that as a large institution with a long-term, view about things, you can sustain as long as your confidence in the overall story. For example, if you talk about India as a story, even the government would have set some target of GDP growth of 6.5 to 7% or so, and the performance was 7.7% as against last year 7.1%. Looking into the resilience of the market, look to the way this, as you were just mentioning earlier, that the way that domestic investments have not only covered 8 lakh crores plus in the last year as against 6 lakh crores equity contribution coming from there. We have been seeing for last 3 years heavy cash flows of around net 5 lakh crores so negative going from FIs, but the contribution which has come from the domestic side is 12 lakh crores plus, almost 30 lakh crores. So that shows the confidence in the entire. In fact, I was talking to one of the CEOs of the bank some days back, and the important and interesting point of discussion was that everything looks so bleak and so many things, but the amount of deposits are going good, credit is going good, economy seems to be good. So this has happened because of very conscious efforts of the policymakers. Today, where India stands, with the confidence is because of the pursuit of the policies which are taken. So understanding that underlying for the country, we have a lot of confidence. We are not getting shaken by, this. Rather than that, we see these as great opportunities because LIC has always been a contrarian investors, and so are any long-term investors. Any opportunity of a dip has been an opportunity for us of an advantage, and history has proven, right? We have about the book value is 9 lakh crores or so, but the market value of portfolio is 16 lakh crores or so. I'm just giving very, abstract or very in and around figures. So what it clearly shows that the Indian story is on upwards, right? We just heard the regulator. The approach of the regulator, even this testing times, is just not on numbers. But he was talking about transparency, he was talking about disclosure, he was talking about ease of business. When the focus of the regulators, the government, the policy makers is on ensuring that the investors and the customers are protected, and the confidence is there, I think we are very confident about that these phases of down are not only challenging, but they are actually opportunities for us. So that gives us opportunity. In fact, we have invested heavily in March, and we saw that at the end of the March, in fact, everybody was saying that Nifty and Sensex were down by 13-11% or so, but we saw that recovery happening within a week's time or so. The same picture which we saw in 2020. We are very confident that India is a very strong, robust growth story. The GDP growth rate of India is going to be, leader in the pack in any ways. And when this country's economy grows, everything grows. Fundamentals are good. Equity is a very good segment, and that very well matches with the expectations of our clients also.
So since you are a contra investor, picture abhi kaisi lag rahi hai? Because we've come a long way from the March lows.
I didn't get you.
How is the picture for the markets looking right now after the recovery that we made from the March lows? When you bought the fear on the street?
Actually, we saw the dip in September. In fact, as far as embedded values are there, we saw there is a very flattish sort of trajectory. But the news are turning out to be good now. We are seeing, correction in the market. One of the factors, another was that Indian PE was almost 22 plus or so, which has already corrected to some level. So we find them as good opportunity to buy. We do not look at these investments from the point of view how it will be at the quarter end, how it will be half year end. We have a time horizon of 3 to 5 years, unless we are doubtful about the fundamentals. As I said, 2 years or 3 years down, everybody is giving 15-16% sort of growth to the market. We are also very confident about it. And but one thing is that equity is not the portfolio that we are looking at. We ensure that equity is a portfolio which gives us incremental value. We have made huge opportunities in the fixed income side also. We are now getting into the alternate investment funds also. So we are looking into, how to get into the larger range of investments also. But we are very confident that this will pay off for us in medium to long term.
But Dinesh, for all the investors sitting over here, and they are individual retail investors, when they see the headlines of the FI exodus which is happening in the market, there are large DIIs like you and many other mutual funds which continue to cushion the market. Do you think FIs should really be given that kind of importance right now when we have such strong hands such as you, supporting the Indian equity markets, and that importance and significance is now diluting by the day?
I will have a slightly, mixed opinion on that or differently. Even with the fact that, our domestic investments are made good for it, I would not discount the importance of participation of FIs. They represent global participation. They represent an outside perspective about the country. And what also is very important is when this, for the long-term growth of the country, investment into infrastructure has to be, really put into now. Investments going only into equity market is not, sufficient for the long term of the company. For example, if you see the domestic, savings in India in 2025 as per the data, it increased by almost 500 basis points from 29% to 34%. But the saving, this is the saving rate for that side, but the investments have only been flat at 14%. Similarly, in the private sector also, investment has slightly gone up by half a basis point or so, around 10% or so. It is very critical that this money which is available in the system ultimately goes towards the infrastructure development also. See, India's strength has been the way roads, we have made the way we have laid down the roads, created the infrastructure. So, FI's money, this is a great thing for India that we have come out of the dependence, heavy dependence on that thing. It's ultimately hot money. But if that money remains in the market, we will have the long-term money available for the infrastructure development. And I'm very confident that these are the phases. We saw it over 2 years back when the money flight, it was because of the exchange rates. 2025 was because of China market become attracting or other markets. I'm very confident that, things will settle down with these political things also getting settled down. The money, FI money will also keep coming back to India, looking at the resilience and strength when we have the confidence of diversity. So I would not like to discount the importance of, foreign funds, let them come, because the government policy also, see, if you look at the recent, endeavors and policy changes which have done by the RBI in the recent policies, allowing, this hedge funding, concessions have been allowed, long-term investments in more than 15, 20, 30 years. So nobody wants to discount the importance of it. But what we want to do is Atmanirbharta has to be ensured. We should not depend upon it. We should create infrastructure and situation and the ecosystem in such a manner that people get attracted and they come to it. We should not depend upon the FI. So that is the approach that we look into it. We don't want to discount it, but we don't want to depend upon the foreign funds.
So if you had one message to the regulator and the government which we could deliver for you, to do something, a policy change that would bring the FIIs back to India, what would that be?
I think they are already doing the steps that they can be taken, because it's very easy to suggest things. But at the end of it, the brains are there who decide the policy. They understand the constraints, the challenges. And I would give that credit to the regulators that whatever is best possible in the situations, they do it. Naturally, they will like to test, because when you release something, there is a cost to it. So they will, in fact, in the insurance field also, if we saw when the Strait of Hormuz has been blocked, the ministry, the regulator all sat down and set up a maritime fund. Okay, Bharat Maritime Fund with those things. All those initiatives are taken, and the success of that will, at times, the idea of these initiatives is to create confidence that we are there with you. And that confidence itself is sufficient to propel the industry. So they are doing what is required to be done. Should we have any suggestions to make, we do it internally. And I can give, this confidence that wherever we have made suggestions to the regulator, they've been kind enough to accept and, help us in the ways possible. I think the entire ecosystem, responsibility is not only of the regulator, its responsibility is also of the participants. I'm very, how I see is, and that has been the strength, the policy making, the regulations, because the regulators are thinking in terms of developing the markets, not only regulating the market. The role is also changing. And the responsibility of the participants, leaving apart black ships here and there, in totality, the entire financial system of India is working very well. And that is the reason the journey is upwards going on.
Dinesh, the one theme that worked really well all through last year and even this year so far has been multi-asset allocation. Do you think in these very turbulent geopolitical times, that's one thing that even Indian equity pure play investors should get straight, that it's not only concentrated equity allocation, but a multi-asset allocation strategy that will work going forward?
I would agree, because, at times getting skewed towards very specific things becomes very challenging. For example, I would give you this example. In the insurance sector, we have seen in the recent times, even for LIC, great traction towards market-linked instruments, right? But and it's very good, for certain times you can sustain that markets are down, keep on buying. But I'm very sure if the markets don't come up in quick time, people will lose confidence and things can fall very sharply. So that's why it's very responsibility of the investment managers and the service providers or the insurance companies, banks, mutual funds to ensure that the risks are cut down, right? People are well educated well, people are told well, and the investments are made in proportion to their risk appetite. They are explained well. So there is a great role there. There's a role where the players and the regulators have to ensure that customers make informed decision. Now, if somebody has got a risk appetite to go towards equity, let the person go. It's no point in telling it. But they should understand the risk and rewards of the thing. But yes, for the larger population, it is very important. As I was pointing out, return on money is more important than return of money is more important than return on money. So multi-asset allocation is very important. That's what our strategy is also. By default, though it is a forced type of regulation, but by default it is good because when 50% of the money is invested in the government security, state development loans, which are giving good returns, it ensures that, to a great extent you are protected. And then you should have right policies even within equity. Like asset allocation within equity also should not be skewed. It should be, again, depending upon the risk appetite and proper experience analysis and proper, proper analysis that investment should be done. But as a recipe, the way this SIPs have been successful, we have seen the investments in SIP has gone up to now 35,000 crore in a month sort of number, which never we could think about it. So that this risk diversification is very important to be ensured through multi-asset allocation, timings at different point of times, because safety of the funds is critical. And because large population is like that, and therefore multi-asset allocation is important, and the importance of that and education of that is necessary.
So a couple of final questions for you. If some retail investor from the audience were to walk up to you and say, Dineshji, in the next 3 years, how much return will I see on the index? What would your answer be?
I would not, hazard any guess on that. But if somebody asks me without fixing any liability on me, right, I'm very confident it has to be a double-digit growth in next 3 years.
Now, double-digit can be 10 to 99.
So as I said earlier, if you noted that, I would expect it to be 15% to 20% sort of range. But again, it depends upon the asset allocations within the equity that you see. It is not that it will be earned uniformly, right? As I was explaining to you earlier, that like Nifty had a 11% dip or Sensex had a 13% dip, but the mid cap had a 0.5% dip only. But that could turn around and change. So which 3 years period time you are taking from which period, it will depend. But it is bound to happen that this class of asset is going to give you a differential margin over a 3 to 5 year period over the risk-free rates. So that is whether you take CAPM model or whatever model you want to build in, that's going to happen. But I would never suggest anybody to allocate your entire portfolio. Maybe it also linked to age profile, your income group in which segment, your disposable income. As they say, the equity allocation should start increasing at the younger ages, taper down at the higher ages. But we today find people with the appetite, higher ages, a lot of surplus money actually going for, in fact, the PFRD has relaxed its regulations allowing equity investments to go up to 75 years of age. So I don't know the way with in this AI times, with the way habits and expectations are changing, 3 years later this world can be totally different. So guessing for 3 years is a big thing.
But you can guess for 1 year. I was being lenient on you and asking you your 3 year view.
Yeah.
We would love a 1 year
But
view
I'm very
from you.
sure that equity as a class deserves at least 20 to 25% of your portfolio at any point of time, and that will ensure that you are able to beat inflation. Otherwise, you will not be able to beat inflation. So that should be.
That's a very conservative target.
And that is a.
That's a very conservative target.
That's
Beating inflation is a very,
For
very.
the institution I'm talking. But for example, last year our exposure was 30%. But going beyond that can be a little risky also, right? Again, suppose the mutual funds are there, which are only equity as a class is selected, you have to go 100% there also. So it depends upon which type of instrument. But, I would be cautious to go beyond 30% in equity as a class for any individual, right?
As of today,
As
from
of-
where you see the markets.
Yes. And then build it gradually from there, right? But going beyond that, unless we have got good understanding of the fundamentals of the company, we have got done really good analysis. Because, see, India has a challenge towards old age pension systems as of now. So we need to ensure, and as an insurance people, we are a little conservative. We would like to err on the side of prudence so that you should not lose out everything also. And they should give you a good combination, 30 to 35% maximum, I would like to.
In the next 1 year, what is the biggest risk for Indian equities according to you after what we've seen play out in March?
The risk, as I was saying, as I was explaining, the strength of the mid caps where they stand today needs to be little, examined. People have expressed concerns about it. Depends on the results, type of results that the companies would show. Some cases of disclosures have, little shaken the market. So, how quickly we can come out of them and how we continue to show the resilience towards these things is going to be the challenge. Otherwise, I don't see anything. I only see this as a buying opportunity. But we should be very calculating and calibrate and articulating selection of the stocks. Getting into equity market doesn't mean that you can get into anything. Still, you have to do research, you have to understand, you have to match it with your appetite and go for it. But equity as a class is very tempting now. I would personally believe that.
Okay, that's exactly the headline we were looking forward to.
Yes.
Thank you, Dinesh ji, for
Thank
your
you so
time
much.
today.
Thank you so much for inviting me. Thank you.
Well, thank you so much for your insight, Mr. Pant, and a huge round of applause for LIC MD Dinesh Pant. He has the trust of 25 crore Indians, and of course the big headline is that the India story is on the upwards,
Absolutely.
Jude.
And not just on the upward trajectory, but also shining bright, given the fact that despite FIIs being in quite a spot, I think DIIs have in many ways continued to resuscitate and also
Absolutely.
take the Indian markets on a bit of a trajectory, more or less keeping it afloat despite trying times. And
Indeed,
that really
Jude.
is
Indeed.
the big takeaway.
And prior to that, of course, we had SEBI Chairman Pandey, who gave us a very important headline, of course, on SEBI Chairman batting on long-term derivatives. He said that the derivative market require development of long-term futures and options. So that was the headline coming in from SEBI Chairman Tuhin Kanta Pandey. So an exciting evening is indeed unfolding, and of course it's Friday evening. We are excited what lies ahead. Exciting panels going forward, of course. And we got our headlines. Of course, Tuhin Kanta Pandey also mentioned how IPO activity has slowed over the past couple of months due to the West Asia crisis.
Absolutely. So moving on then, everyone is chasing the same stocks, the same themes, the same returns. But when the whole market is crowded to a handful of trades, the easy money, Shibani, is long gone. So
Right.
the real test now is finding an edge that others have probably missed. Finding alpha in a crowded market. That's the theme of our next conversation. And to moderate this panel, I'd like to invite back on stage Aisha Faridi at ET Now. And she will, of course, also be joined by Sajid Mangat, Senior Executive Editor at ET Now and ET Now Swadesh. And please join us also on stage, our panelists. There's Sunil Singhania, that's the founder of Abacus Asset Manager LLP. We're also being joined by Sandeep Tandon, CIO at Quant Mutual Fund. Nilesh Rajban, President and CIO of Equity Investments at Nippon India Mutual Fund. Sajid, Aisha, and gentlemen, let's
Please
have you
join
all
us
on
on the
stage.
stage. And a huge round of applause, ladies and gentlemen. Where is the Josh? I know it's a Friday evening, but we want some excitement from the audience in welcoming our panelists and Aisha and Sajid on the stage. Over to you, Aisha and Sajid. Thank you so much.
So while the LIC chairman obviously wouldn't talk sectors or stocks, I'm hoping the gentleman to our left would. I tried hard, but obviously. But gentlemen, thank you so much, all of you, for your time today. And Sunil, okay, you're getting your mic. I thought you were having a sip of water. Mic. Yeah. The camaraderie in equity markets. But, Sunil, I have to start off with you. You know, today while coming to this room, and I knew we had to talk to you on this panel today, I was really thinking about the time when you told me back in March that you're sticking your neck out, that 90% of the correction is behind us. And rest assured, one day after, we've not seen those Nifty levels back. The Nifty bottomed out. From where we were in March to where we are now, what are you feeling about the equity markets? Because I remember you also telling me that crude will break 100, we will break 90 also, and all of it has played out. So crystal ball gaze for us, what's going to happen next?
Thank you for making me sound like a guru, but see, one thing is last 20-25 years, if you would have asked me this, I would have always said that markets are looking good. So that is there. But I think all said and done, last 2 years have been full of challenges. And, you know, one after the other, whether it was the AI trade, which was anti-India, the 1 year of, uncertainty over tariff, and then obviously the West Asia war where crude shot up to 120. I think against that, we have seen a lot of government actions. We have seen GST cuts. We have seen the economy revive and recover superbly post the GST cut, starting October 25 to even now. And corporate numbers have also sort of surprised on the positive side last 2 quarters. So I think at some point of time, our view was that this war cannot last forever. And obviously, you know, if the war is not going to last forever, so it's a matter of time before sanity prevails. Actually, it's lasted longer than what we expected. On the crude side, March when the war erupted, it was not only about the price, but availability of crude and gas. I think even now, even before what has happened over the last couple of days, availability has not been an issue. So there's more than enough supply of crude. In fact, our view still continues that once this is settled, there will be so much supply. And on the demand side, every country is acting to ensure that they move away from only fossil fuel-based energy into maybe electrical energy by way of renewables and so on and so forth. So I think things definitely look like bottoming out. Obviously, you know, there is always uncertainty. That is what the markets are about. But as we speak, I think we are in a very, very good spot now.
I will probe on that good spot in just a bit. But Sandeep, for a data-driven fund house like you, you're all about data. What is the data telling you right now when you look at the ticker? Or is the data now only tracking Truth Social? What are you tracking first? I want to start with that.
So the way we are looking at data, if I have to talk about purely from a predictive analytics perspective, in fact, 1st April we wrote, it's time to capitalize, not to capitulate. Okay, and we talked about how after 2 years we turned positive on small and micro cap also. So if I have to look at purely from a behavior perspective, we have reached a stage where people have virtually given up India. We have never seen this hatred feeling for India. Okay, any conference you go abroad, nobody wants to talk about India, and these are very classic behavior signs of bottoming out when people give up at the bottom and verge of giving the bullish thought process. If you look at the best strategists who are very bullish for a longer period of time, in last 3 months, best of the global houses have given up on India. And I think that's a data point which we track, and we spotted that opportunity. We saw a capitulative move happening in the mid and small cap, particularly in micro cap also. So that's a very classic sign between January to March it happened. So we were able to spot that opportunity. Now the real question comes way forward. I think the way we look at India, I don't think it is not about any indices in particular you have to track. I think it's all about company-specific opportunity. So you have to ignore the broader indices and focusing on the stock-specific opportunity. I will say Even sector themes are becoming difficult. It's becoming a very, very stock-specific opportunity where you see grossly under ownership, undervaluation, hatred feeling. Those are the space which will generate alpha for this year.
Shailesh, you've been managing one of the largest funds. Which are the sectors where you're seeing opportunities at this point in time?
Thankfully, because of so much of FI sell-off, there are opportunities appearing in many, many segments of the market. So these are the times of all the bad news and actually very good prices everywhere. So private sector banks, clearly the cheapest ever valuations for most of these businesses, and rock solid credit quality and all that. So there is a lot of opportunity there. Pharmaceuticals is another space where there are sensible valuations, very low expectations. Consumer sector where valuations might be high, but expectations are so low that nobody believes more than single-digit growth is possible. So I think the best part is where there are very low expectations, there will be massive surprises in the next 2 or 3 years. And I think those are spaces we want to deploy capital. Private sector banks comes an important area, consumer comes, pharmaceutical comes as an important area. And even IT services, I mean, it's possible that things will shift. They will not decelerate the way people are talking about. And at 6-7% earnings yield, some of these might become interesting. Each of them with 2-3 year time frames. I mean, I think it takes time.
I know Sunil doesn't have any investment in IT services. Shailesh is betting on it that it may be there's a reversal there. Sunil, what's your view on IT services?
No, I think, Shailesh is a IT and pharma guru, so I respect him. I'll go and introspect why I don't have IT services. But I will give our perspective. I think 5-6 months back, our view was that, one, obviously, this AI trade, I don't know how it will play. But one thing was sure that in the near term, there is so much uncertainty which has been created that there will be some impact in the near term. Second is Indian IT services company themselves were guiding for 3-4% growth. So, even if you believe that they will achieve what they have guided, there was not too much of upside left. And I think the most important thing was, Indian IT services companies, unfortunately, are headcount driven. And none of them were hiring people. So if they're not hiring people, how will the revenues go up? So I think that was a call which we took. And despite what happened to the rupee, I think it's played off beautifully. I think we just have one product company in our portfolio. At this point of time, maybe the prices have fallen and maybe there will be a bounce back. But I think our view is that it will be maximum a bounce back. And therefore, our view is still not very constructive on the pure play IT services.
Sandeep, that's the problem with the market, that it's become so trade in, trade out and very stock specific. And that's where the retail investors are sort of grappling with catching up what the market has to offer. And I don't blame people also because, look at the news flow, look at all the volatility around the world. It's difficult to make sense of the madness right now. Behaviorally, at times like these, where do investors tend to shift? And would they gravitate towards safer plays, traditional old school defensives, pharma, IT? I don't know. What's your view on that?
So I will answer in a different manner. See, if you really look at last 2 years, okay, globally I'm talking about, in India also, the quasi-passive style of money management has not worked, which has been the forte of most of the fund houses. You mimic 70-80% of the indices and try to create outperformance of 10-20%. But if you look at the globally, okay, you have seen a skewed trades happening, okay, and people who have who has actually able to play the skewed structure were the biggest beneficiary. If you leave India, then you classic example, how about Korea, Taiwan, and even in the US market. I think that is the way forward also for India. That quasi-passive strategy will not be very effective. You have to stick your neck out and showcase your conviction, whatever way you identify the stock. And I think that's the way we as an industry will have to change. And I think that this change is quite visible globally, and I think we'll adopt. So that's the one data point I want to talk about. Now, obviously, from a retail investor perspective, that's the reason we always say mutual fund is the better route. It's the most tax efficient structure. So if you have to rotate your portfolio, churn your portfolio in an effective manner, then you can't have a better vehicle than a mutual fund, because purely from a taxation point of view. But what is more important, the mindset has to change. Okay, this thesis of buy and hold, I think that era has passed. Okay, so that's a big thought process. We live in a very dynamic world. Data points are changing on continuous basis. How can we say that our money management style remains static? So you have to be dynamically, and this is what up to small extent we are trying to do.
So where is it that you're aggressive and where is it that you're conservative and where is it that you're completely ignoring?
So we have played our data center thing, because that's the only way you can play AI theme in India. So we were skewed towards telecom company, power in a big way, select product companies, okay, cable companies. So that's the way our skewness, obviously, since we were very skewed towards power companies, it has worked in our favor. So we remain very constructive as a power, as a theme, because it's not about people are shifting globally from fossil fuel to the renewable thing. And maybe by 30, 31, 32, India will be a very formidable force in the renewable side. So that's the one area which I feel the energy space or power space, particularly in the renewable side, should be your core to your portfolio. And given the uncertain environment which we are living right now, and there's no certainty that Trump mood will not change today evening. So based on that, obviously we are underweight on the manufacturing. You can't be 100% own services space. Idea is that if you can reduce the weightage on the manufacturing side, given the uncertainty which we are facing right now, more from the input cost perspective, trade related challenges. So it's more skewed structures which we are playing, and choices are very limited.
Sunil, as a fund manager, how do you manage the Trump factor, which comes in every day in the morning before the market opens? And in the whole thing, how do you generate alpha for yourself?
See, one thing is, from childhood, हमको story सुनाई गई थी, शेर आया. So the impact of that शेर आया keeps on reducing. And I think that is what is happening. And in fact, if you remember, when the war started, even the slightest indication that the war is going to escalate, oil prices used to shoot up $10, $12. Now even when the missiles are being fired, oil moves up $2. And when the news comes that nothing is happening, oil moves down $2. So I think the street is also realized that, you can't dance to the tunes of someone who's been so erratic. In fact, I was reading 39 times Trump has said that the war is over. So now when the war actually will be over, no one will realize it. So I think at some point of time in the near term, you have to read all this because you have to be busy. But I don't think you can change your portfolios based on, statements from someone who's been so erratic. In fact, for the first time, we are waiting for Trump's birthday, because at least on the birthday, he will do something which is going to last for a long time. So I think you just have to enjoy rather than get stressed about what he's saying.
But Sunil, as an individual investor, and you're much like a stock picker style of investing, much like Sandeep as well, do you completely cut the noise?
No, you can't. Definitely you can't. But you can't react to every noise.
Of course.
So you have to hear the noise, but you can't react to every noise you hear. And I think with experience, with patience, you start to learn of, maybe ignoring 90-95% of the noise. So even the media channels are silent in our office.
Thanks.
Sailesh, how do you look at, the noise, especially from a retail point of view? We have SIP flows which are coming in, 30,000 crores on a monthly basis. Despite the fact that, there are news that last 2 months we saw net SIP closures which were coming in there. From a retail point of view, how do you manage that kind of expectation when 30,000 crores comes every month to the entire industry as SIP, and that needs to generate and return, and for the last 2 years the index has not given much returns?
So I think the best way to look at this is last 2 years are a chosen time frame which we have chosen. Prior to that, they were extraordinary returns and they were all unreal, right? The good part of SIP money is it comes in smaller tickets, it averages out, and generally tenures are fairly long. So that allows for reasonably good experience. See, please look at it like this, right? if you say or try to time and create portfolios or invest at the point of time, good news is there, which was the case in September 2024, the next 2-year returns have been bad. So when there is bad news like this kind of money is welcome. See, why this correction has happened in the market, right? One, we were expensive. Second, you've got maybe $40-50 billion plus sell-off of foreign investors. So all this is creating good prices, and a lot of this capital is going in retail investors putting money at the reasonably right point of time. It's just the time frame you need. You need that 3 years, 5 years to make money. There is no free money in equities, right? The returns have to come with underlying business earning recovery. And as it happens, why will the investors with meaningful time frame not benefit? So we don't see this as, we see it more as a structural opportunity. If people have 3-year, 5-year, 7-year opportunity to put capital to, right? I think India has enough and more to offer. Nothing yet has happened in India. So I think medium-term, long-term money in systematic tickets will make a lot of difference to long-term returns of investors.
But you know, Salesh, I think you hit the nail on the head. The nature of money that's pooling in the market right now is that small ticket size, discipline. I will park so-and-so in my SIPs because that looks like the best time. Look what's played out from COVID. You know, animal of habit, and you will do that in a disciplined way. But that aggressive, hungry, hot money, as we used to call it back in the day, how far are we from that kind of money to come back in the markets?
I think that money will chase. If markets start behaving well, it will start chasing the returns at the point of time. See, the most difficult thing in markets is to sit quiet. And I think that phase is what we are going through, right? If few things turn, like Sunil talked about oil, right? People will start putting it that next 12 months are starting to get better. I think the minute you get that signal, currency stability, that kind of a signal which is there. And today the best thing is, because of this sell-off, world-class business are able at sensible prices. So I think it's a matter of time where people start looking at opportunities which are there. So whether you call it hot money or maybe even FII money or whatever, I think it will chase when you get returns which are earnings which come back and, you know, the opportunity becomes good. So I don't see it as, in fact, it's not there means it's very good for investors.
Actually, that money was chasing gold and silver 6 months back. Yeah. And now that money is chasing,
what to do.
That money is chasing Korea now. So, you know, we'll wait for it.
Sandeep, I just want to add out here, since we're talking about a retail behavior perspective. This sort of, earlier we used to see hot money, which you talked about, you know, we used to make fun of retail money, gaon aa gaya, you know, top pe aata hai, okay? I think the phenomena has changed. Retail investor has become more mature since of late we have also dealing with this sort of mindset. And I'm also giving from a background that every bull market has a leadership, okay, from a participant perspective. When bull run started in 2003, June 2003 globally and India particularly, it was led by FIs. We have not heard so many names of Tiro and Janus and all those names, you know, they're new to us also, okay. They took that advantage until September or October 2007, they took that advantage. The next run, which was started in, let's say, April 2009, was largely driven by the HNI family office. You've seen all the PMS growth happen in that period. And maybe the limitations were there, you know, how many family office, how many HNI, 5,000, 10,000, 15,000. The April 2020 bull run is led by retail, okay? And that is the new leader, okay? And he doesn't get affected with 15-20% fall in the market because mark-to-market gain, which he has made in last 4 years, very meaningful. And look at the base of retail investors, very large. So this impact will last for a few years or maybe few decades. So it's not going to end this so easily. That's the reason best of the people thought this is the peak of the retail flows, okay? Now, last 1 month we are marginally down, doesn't make any big difference. But if you look at on a YOI basis also, we are doing extremely good in terms of flow. So I think this is a wealth creation phenomena. Something has changed. We have to also change our perspective in treating retail. I don't think it's a hot money anymore, okay? I don't see that sort of feeling which is there. Yes, we also saw some euphoric move happening between September last year till January, February on the gold and silver side. That, yes, it's bound to happen in India also. But otherwise, it's a very, very mature behavior. When market falls, we see our inflow increases. When market rallies sharply, we see some amount of redemption. So the perspective has changed. And I think I have a lot of respect for a retail investor now.
Yeah. One of the big things which everyone talks about is the earnings growth. And you look at small and mid-cap companies, and we've seen a better earnings growth coming in from the mid-cap space and the small-cap space. How do you look at the entire thing? Do you see the investable pool of companies in this basket of small and mid-cap have increased in the last 5 years?
See, yes, it's true, because see, we have to don't look at just the entire capital market breadth and the depth of the capital market has increased. Okay, obviously the pool is the number of IPO comings, number of the QIPs happening, or the promoter offloading, or private equity offloading. So obviously retail investor base has risen significantly. So both depth and breadth has become meaningful for us. So I don't think a lot of people ask this question to us, a small fund, easy to make money, okay? But I say we are also not growing in isolation. The entire industry is growing along with the industry. When you talk about the capital market depth is increasing, so I don't see that as a challenge. The only challenge is there, the mindset of chasing few stock, the skewness part, which we have seen, and we have suffered as an industry. We have skewed our portfolio to few names and those few names becomes now trade in the admired territory, and now we all have seen the pain of grossly over ownership. So I think it's an opportunity to look for some of these under-owned names. And there is enough opportunity available there. Valuation comfort is there, under ownership comfort is there, and people have ignored it completely. So those are the areas which you look at.
Sunil, is that the way money will be made? Look for bottom-up stories?
I think that is always the case. It has to be a mix, obviously. As investors, as portfolio managers, you'll have to balance between the two. But I think I agree. India is a country of entrepreneurship. So many new stocks, so many new themes, so many new entrepreneurs are coming in. And obviously, some of the new age themes, Sajjan mentioned about the mid and small cap results being good. There are segments like niche manufacturing, engineering, which are necessarily smaller companies, which have done very, very well. And I think the outlook is also good. So at some point of time, you will have to be stock specific. But stock specific does not mean only small companies. Stock specifics can also be in large companies. Now, if you see, there are so many companies who for 5 years have given zero returns. So it goes back to what we started saying in 2019, that the best company is not the best stock. There is bubble in quality. And all the so-called quality stocks have given zero quality returns, 5 years, zero returns. So even in the large caps, one has to be stock specific. And I think that is our job. We charge 1% net fees, and I think the investors deserve us to do justice to the fees they are paying, So whether it is large cap, mid cap, or small cap, one has to be stock specific.
But Sailesh, Dinesh Pant from LIC was just saying that he's a little cautious about the mid-cap end of the market. Do you believe that that's where large chunk of the flows are concentrated in, and it is maybe a little frothy in pockets?
See, the consolidation has been fairly significant across. So within each segment now you're getting opportunities. So unlike in the past, only large caps were giving opportunities because of the sell-off and all that. Today you're finding opportunities in most pockets. Maybe it's possible that maybe in large caps, maybe 60-70% of companies' valuations have become sensible. In mid caps, maybe that number is 40%. Maybe in small caps, it is 50-60% because of the correction which has happened. I think the debate on which capitalization, which space, which opportunity, I think it's about good companies versus bad companies is what the bet has to be at prices, at sensible prices. So within each category, if the growth rates are higher, there is some premium definitely required to be paid. But I think today when you look at it, you are getting good quality, sensible businesses across the spectrum now. It's no longer just one space which is very attractive and the other space is completely outlier. You'll not get a bet kind of a thing. So it's much more sensible markets.
Sandeep, I think the other debate is also how much to India. Sunil gave the example of Korea, gold, NASDAQ. I mean, pick up any of the world markets. Is that the way now the Indian investor has to approach? Don't be just concentrated in India. Look at other global markets as well. You have to be multi-asset, multi-country approach.
So, frankly speaking, this sort of thought process only comes after you have seen a massive move in a particular asset class or country. And that's the reason everybody has a left out feeling. But as a risk manager, if I have to look at from a purely from a risk perspective, and we always say we are in the business of risk management, returns are byproduct. So when you talk about risk, I think India is more safe. Okay, we have seen exhaustion in the rupee also. Okay, we think rupee cycle has, a depreciation cycle has peaked out. I'm not saying the levels, exact levels, but we are closer to that peaking cycle, not the breakout cycle, which a lot of people look at. Second thing, the exhaustion we are seeing on the FIs side, okay, which is obviously linked with the currency movement also. And the most important thing is not about absolute numbers, it's about the relative returns. We have underperformed for nearly 2 years now, global markets, which is never the case. So obviously from a risk perspective, India looks much more safer, where we are seeing signs of euphoria in Korea market and Taiwan market, okay. Something similar we are looking at, maybe if not immediately, next 1 month's time in the US market also, because one of the largest market cap companies are getting listed, and there's an urgency to shift by selling some of these and participating. These are very classic sign. We have seen in India also, one of the largest market company got listed. In past 2 occasions we have seen the top of those stocks and the market also. I think I have a similar feedback that even US market has a potential to correct sharply, if not now, in a month's time. Okay, Korea, Taiwan, the process has already begun. So purely from a safety perspective, India looks a much better option rather than looking for these opportunity. Obviously, diversification is a good theme. You should always diversify. But diversification virtually at the peak of the cycle is not a great idea.
So you'll have the largest allocation to India.
Sunil, the biggest debate now is about flexi cap and multi-asset funds, actually. You manage one flexi cap. How do you resist from become multi-asset in that?
See, I think from an investor perspective, obviously different investors will have a different horizon and a different risk-taking ability. Flexi cap is the best fund because it gives you flexibility to do anything you want, right? But obviously some of the well-performing flexi cap funds technically have become large cap. So I think the name is flexi cap, but you have to do justice to being a flexi cap. Multi-asset, on the other hand, is a combination of a lot of asset classes. So you have fixed income built in, you have gold built in, you have commodities also built in, and maybe equities also built in. And I think it gained a lot of attraction because of what has happened to gold, particularly over the last 1 year or so. When gold and silver did well, obviously in a scenario where equity markets are not giving you any returns, I think at least because of that 10-20% weightage to gold and silver, and because the way the prices moved, you were able to make decent returns in multi-asset fund, and that's why there was so much money which came in. That is not to say that gold and silver will continue to perform, I don't know. But for someone who doesn't want to take a volatility risk, I think diversification across asset classes will always reduce that risk. So maybe, there is room for multi-asset fund. But my view, frankly, on gold and silver, I don't know what is going to happen near term, but I think they have long cycle asset classes. I don't see them doing too much in the very near to medium term. And multi-asset is basically balanced fund with gold put in. I think this has always been a great sort of a fund, and it will always remain a good fund to be in.
Sandeep,
I just want to add,
please.
Okay, on a lighter note, regulator has recently allowed you can invest, any equity scheme can invest in the precious metal space. So technically all schemes are multi-asset funds in that sense.
But where will alpha generation be? That's the question.
So obviously alpha is all about timing the market, okay, which is not going to be easy. At the peak of the cycle, everybody was so excited. But I will look at this gold silver exposure from a risk perspective is a good diversification, because what happens, you are unable to control the beta in a difficult environment. And if you have a flexibility to deploy money in some of these asset classes, provided you can time it better, then you will able to reduce the volatility of the returns significantly. It's a good development. I look at from a risk perspective, I appreciate what regulator has done. A lot of people are not liking it that I'm managing only flexi or I'm only small cap centric, I'm mid cap centric. So I want to remain like that. It's the approach. We as a risk manager think is a better opportunity. It gives me better diversification. I have a flexibility in difficult time to park my money rather than just holding the equities in a difficult. And this is what happened in mid and small underperform significantly in the challenging environment.
But a year from now, what will make more money? Equities or gold or silver or any other asset?
So if I have to share my view, in the January we talked about the cycle has peaked out for gold and silver both. And I think we are still in the downtrend. We are in a structural bull run in precious metal, but in cyclical downtrend. Okay, and my targets are relatively more aggressive. It is at that level 55. We talked about minimum 4,000, and if it happened to 36, 38, don't be surprised on the gold. We are very closer to that number, and silver minimum 64, and don't be surprised to see 48 levels or so. So we are approaching that number. We are confident you will see these numbers in this year itself. And that should be a good opportunity.
See, actually what happens now, narratives start to build in when the prices move up. When silver became 100, 120, people said solar lagne wala hai, for every cell you need this much silver, there won't be any silver available. Now the solar target is double, tripled of what was the case 3, 4, 6 months back, but the prices have come down to $64 or whatever, you know, and Sandeep is an expert. If he's saying 48, 50 to hi jayega. So I think narratives built in only when the asset start to do well, you know. If you look at the two companies, you know, SK Hynix has added $180 billion to its turnover and $175 billion to its gross profit. So the entire move has come from price up move because no one set up capacities, memory chips and all were supposed to be commodities, and there's suddenly a shortage. Now if you believe that there's going to be shortage forever, then you are better off buying them. Otherwise, you know, it's going to be you know, a very bad experience for someone who just bites the bullet because the last 1 year has been good. I don't think anyone in the audience knew the name SK Hynix 2 years back, you know.
Shailesh, what's your view on this?
See, where there are narratives, the money is already made, right? So where are there no narratives today, right? One is India is the market where nobody wants to touch. I mean, there are conferences, a lot of people coming internationally. Nobody wants to invest today because there's some other segments of the market which are making money for them, right? Within India, the largest of the largest businesses which make 80, 90,000 crore operating profit are at 13 times multiple. And nobody wants to touch them. So where there is so much of, I would say, anti-narrative as that would be the trade or a negative narrative on those trades, I think there is tremendous opportunity lying there, right? And various other sub-segments which you talked about, I think I agree with what Sunil and Sandeep have talked about, saying that I think the peak euphoria for some moment is gone now. I mean, I think going back to them immediately is not an answer. Use those asset classes as important asset allocation strategies, right? Because timing them, getting them right, you can't keep doing it repeatedly right. I mean, you do it more, maybe less often than you can actually think one can do because of the challenges. So using equity as a core opportunity today because there is no narrative. People talk about very large businesses as passe, you know, in the sense, you know, they are not there. I think things will turn and this segment will give you possibly great opportunities or great returns.
Sandeep, couple of themes that you've liked, pharmaceuticals, for instance, and we've been talking about pharma as a theme for the last 1 year. You were, you know, very visionary talking about what GLP-1 will bring to pharma, and you can't imagine what kind of, you know, an explosion we've seen. We've seen that play out. What's the next pharma now? What will give that kind of return which select pharmaceutical stocks have?
To be very candid, Shailesh is the best person within us to talk about.
I was just telling him, kaan mein pehle bata de, baad mein bata.
But as a theme we like, okay, I see a lot of money will shift from IT to pharma. This was our call that we have seen extraordinary growth, and if you see challenges out there, and given the rupee weakness, this is the one sweet spot, okay? And sometimes they're in a very commanding situation. They don't pass the currency benefit also, which is not the case in IT company. They pass it, okay? So I think that's an area which is still under-owned by most of the FIs, okay? Yes, domestic mutual fund has a fairly good exposure to that area. And being a complex sector, many HNI family office also don't participate. Everybody has worry about FD alerts and import alerts coming. So none of the analysts can also predict that. But I think if I look at the basket approach, that's the area which I like. Maybe Salesh can talk about more themes. But we like that space and we were early to capitalize that opportunity.
Sunil, top sector exposure right now?
I think at this price, some of the really beaten down private banks, I would agree. You know, the blue chip of blue chip private bank is now trading at 10.5, 11 times P. If you strip down its subsidiaries, I think, you know, it's better to put money in that company stock rather than put money in that FD because the earnings yields is 9.5%. But I think we like capital market plays if we get an opportunity. Pharma, I completely agree. It's a safe sector. It will benefit out of the tailwind which we have. I think engineering, particularly India, has opportunity because it's a very entrepreneurial-driven sort of a sector. But the good thing is, you know, we don't look at sectors per se. So, you know, agar acha hai to we just invest. So that is, but these are the sectors where we have. I think from a Nifty perspective, there is not too much of room to go down. Because sectors which have got beaten like IT, you know, they can underperform, but they can't go down further. Private banks cannot go down further. So I think Nifty generally, I think is in a good space to give you a good, like a quick 7-8% return.
Interesting.
In how much time?
I said quick.
You're speaking about private sector banks.
Quick is what? What is quick? Quick can be an hour.
Like 2-3 months.
2-3 months.
You're speaking about private sector banks, but what about public sector banks, Salesh?
See, the trade is shifting totally, right? 5-7 years back, public sector banks were extremely cheap. Today, private sector banks are slowly coming to public sector valuations. So I think the opportunity in public sector banks would remain as an independent opportunity, but private sector banks are clearly at throwaway valuations. In fact, the best of the banks in India today are at bankruptcy valuations, I would call them, boss.
Okay, Chalo, great. We got some good sector ideas as well from all of our, you know, experts sitting here, and I hope you guys got some knowledge as well, listening to them. And good to speak with you guys as always. But Sandeep, what is the indicator on the Nifty? You were bang on for gold and silver. Nifty ka target kya hai?
But if I have to say whether Nifty will make a new high, I think significantly new high will be made by November 2026 itself. And that's a broader call. And this will be said in the January also. This is you will see in the beginning 2025, this difficult question was asked. And fortunately, I was right.
But Sandeep, you know now, we journalists don't settle with these phrase kind of answers. You have to give us a number. Significantly higher means what? That can be 27,000 also.
Yeah, it can be easily. It can be easily that number. So I tell you, if things changes, anti-AI thesis plays out well, I will not be surprised if it happen in one quarter also. Okay, that is what is sometime momentum. Look at small news came today, Nifty was up 500 because the shorting is going on. People, if this news is, let's say, certain, then the covering itself can take the Nifty to the next level. Okay, so I think we are in that stage where people have given up, people have short position, and any positive news, there will be urgency to buy. Okay, so you will see sharp spike again. So I know you have to take advantage of that.
So 30,000 you said, right? Okay, for another time. But ladies and gentlemen, a huge round of applause for our esteemed panelists.
Well, I think one thing can be said for sure, Shibani and members of our August gathering. If there indeed is a quest to unearth that alpha in a crowd, the right place and the right time to do it is right here and right now at the ET Now Market Summit. So on that note, thank you very much, Sunil, Sandeep and Nilesh, for those valuable insights. And before we move on, a sincere thank you to our partners who've made the ET Now Market Summit 2026 truly possible. Remember, the ET Now Market Summit is co-powered by PhonePe, our mutual fund partner, which is HSBC Mutual Fund, and our associate partner is LIC of India. And remember, to all our audience members, please remember to share your thoughts through the evening using the hashtag ET Now Market Summit 2026.
Absolutely, Jude. Now, retail investors often follow the headlines. The smart money moves quietly well before the rest of the market catches on. So the question worth asking is where those big patent bets are going right now, where smart money is deploying capital. I'd like to invite Aisha and Sajid back on the stage to moderate this discussion, and I'd like to invite the thought leaders on the panel. We have Utpal Seth, he's the founder Mentor Trust Group. We have Sridhar Srivaraman, Investment Director, Enam Holdings Private Limited, Hiren Ved, Co-founder Director and CIO, Alchemy Capital Management. Gentlemen, if you can join us on the stage, and Sajid and Aisha, please join us on the stage again. And a huge round of applause from the audience that we are expecting. Now, come on, guys. Let's welcome our guests, the panelists, and Aisha and Sajid back on the stage to discuss, where is the smart money being deployed right now. Over to you, Aisha and Sajid.
Okay, so we are going to get now more focused. We've got three gentlemen who will hopefully talk more micro. They will give us more themes to invest in. And that's really the purpose that all of you should be more seasoned and more wise when you walk out of this door today. So, Utpal Seth, I'm going to start off with you. Tough finding gorillas in this market, as your style is always, finding gorilla themes?
No, it's not tough. Since September 2024, I think we've been in a stealth correction. While the damage to the index has not been much, but the correction in the median valuations has been material. This is a good time to be finding gorillas.
So, where is it that you're finding opportunities? Or actually, let me ask you differently. Up until the March lows or up until yesterday, where is it that you've been deploying money? Let me ask you that.
I'm all in equities. So that's the only game I want to play. And I think this is one of the best times in recent history. Let us step back and look at this. We have material disruption, technology disruption taking place globally and in India. Such disruptions cause value migration. We also have selective dislocation, where, as I said earlier, median valuations have corrected. And we have a set of new genre of companies and entrepreneurs which are getting listed, which are providing access to public market investors like us, to companies which have a new version of business models, new go-to-market strategies. This has happened after quite a long time. Add to that, whatever disruptions we are seeing globally, either with regard to geopolitics or economics, our government has been responding to that. Let us connect the dots. We will have a larger fiscal deficit this year, as the government has said. To my mind, that is a fiscal stimulus to the economy. Our rupee has depreciated. To my mind, that is an external stimulus to the economy. It makes us more competitive. With this FCNRB structure, who knows if we get $50, $100 billion coming in, to my mind, that is an indirect monetary stimulus to the economy. And the tax break that we gave to data centers for 25 years, that is a policy stimulus. If I add the fiscal stimulus, the monetary stimulus, the external stimulus, and the policy stimulus, all the ducks are in line. I think good times are ahead of us.
Sridhar, from your economic hat perspective or perch, you know what Utpal was saying, it's such a dynamic world. There is so much that's changing. There's so much that's happening in the world that you've got to adapt to.
Yeah.
There's so much happening in other asset classes that you've got to adapt to. There's so much in economics that you've got to adapt to. And then, of course, you know, geopolitics, politics, and all of it. What is your frame of mind as an investor today?
So broadly, my view is you should have a good asset allocation. So my view is you should have, say, 10-15% in international equity. I've been investing since 2015 in international equities. About 10-15% in gold, which is one of my favorite asset classes apart from equities. And of course the rest in equity. So that's a broad framework. When you have an asset class which is reasonably diversified, like say last year gold did very well, equities didn't do, but then it averages. Your average still looks reasonably good. So the benefits of asset allocation helps over a long period of time. So I would say broadly that by diversifying your asset classes, helps you to mitigate risks of any particular geography or any particular asset class.
Hiren, is all this dynamism and all this volatility purely in terms of data points in the price now? What you see on the ticker, has the market digested all the repercussions that we're going to see in the next 6 months? Or is there still room for more volatility, you think?
No, I think, you know, in today's day and time, news gets discounted very quickly. But there is a difference between discounting news and trying to discount the reality, right? And sometimes there is a gap between the two because, as I said, the narrative builds up. And the narrative may be right or it may be wrong, only with time. And in hindsight, you get to know that. So I think as investors or as asset managers, we are constantly trying to figure out if there is a trade-off between that narrative and reality. Or also sometimes people give up because within a long-term structural cycle, there may be short cycles of underperformance. Let me give you an example, right? In mid-2024, when the expectation was that this government will get a complete majority, and they did not, right? So while they had to take support of their NDA partners, I think suddenly the theme on defense, on capex, just gave away because people immediately reacted to that news to say that ab to capex nahi hoga, right? Ye ho gaya. Ab, you know, ye ladli ben, ye vana. So everybody, if you remember, went and bought consumer stocks, right? And finally what happened? So maybe these sectors or companies underperform for a year, but the reality caught on and the trend reasserted itself. So I think today there is always the, you know, we want to discount every news very quickly and make sense of it very quickly. I don't think long-term investment works that way. You have to sometimes step back, think, and really understand whether this is finally what I have seen over the years in the markets is that finally numbers speak for itself. Right? Narratives can come and go, news can be good and bad, but it's finally the narrative that matters. So for example, something which is very recent, right? Now Trump may flip and flop every morning and evening, but whether we are coming closer to a resolution of the war or not, the oil price will tell you the story because that's a reality. Because all the wisdom, all the risk taking, will get reflected in that one variable. And, you know, that is more important than somebody saying yes or no early in the morning. So I think I would say that we have to step back and look at what the long-term structural trend is, where the money is going to be made, and then stick to it. Have the ability to stick to that. And that's where the money is going to be made. Not discounting the news every day, every week, every month. Doesn't happen. You can do a lot of activity, but you don't make money.
So Hiren, what is the narrative? What is the reality? And what is the structural story in the long term?
Well, I think there are more than a reality. I would say that there are a few trends that are very clear now post-COVID, right? I think that one, in my view, we are in a global capex super cycle. And whether it is because of disruption, geopolitics, wars, oil shocks, I think it is very, very clear that today every country has realized that when it comes to certain foundational capabilities, defense is a foundational capability. Having access to semiconductor technology is a foundational capability, right? Having energy security is a foundational capability. I think every country in its own, every large country which has an ambition to become big is today trying to figure out how they can be self-sufficient or hedge themselves. How do you hedge your supply chains? And I think that is driving a large capex, global capex cycle. And that is a reality. Now, how you take advantage of that is then comes down to the more micro thing about whether you buy a pipeline company or you buy a semiconductor company or you buy, you know, a defense company and so on and so forth. But I think this trend is unlikely to go away. So even if the war stops tomorrow and oil prices were to come down, as a country, we can't stop investing in electrification. We cannot stop in trying to do capex to get our energy security, right? Because it's, you know, you've been hurt and therefore you have to address it at a very fundamental level. So I think that that is not going to change in my view. And this has been happening. And alongside all of this, we are seeing this whole huge AI disruption, right? And there will be several layers to this. We are also benefiting. I mean, you mentioned about what is the narrative. Somebody also asked me, I was at one event, your sister company event, right? And the big narrative today in India is that India has no AI play, right? Agar aapko AI khelna hai, you have to go to US.
Anti-AI trade.
Huh?
Anti-AI trade.
We are an anti-AI play. So I'll tell you that, you know, currently in AI, most of the spending is happening at the infrastructure level. So people are setting up data centers, you know, blah, blah, blah. And I gave this data. I told my team to build a custom India AI index, right? So these are all physical stuff like power equipment, cooling equipment, cables, everything that goes into building a data center. A equal weighted 12 stock India AI index in 3 years, in dollar terms, has delivered a 52% compounding return versus Mac 7 plus NVIDIA, which has delivered a 24% compounded return, right? So the point is, if you look hard enough, if you are creative, there is always a way to play a trend. Or you could sit and say, India mein koi AI nahi hai, mujhe Korea jana hai, mujhe America jana hai, right? I mean, there's always a choice. So I think narratives are narratives, and the more the narratives are there, the more I think there is a opportunity to make money, because you can find an anti-narrative, you can find the reality which does not, the narrative does not represent, and that's where the profit-making opportunity is.
Utpal, much like, you know, what Hiren was just saying, foundational opportunities, structural opportunities, that's been your style as well, right? And we've talked about it over the years. You did talk about data centers, but beyond that, what would you think has to be part of your core portfolio right now? Themes.
So, to build on top of what Hiren said, if we go with the hypothesis that there is a global capex super cycle, and India is participating in that, whether along with the global cycle or a little behind the global cycle. If you also accept the fact that there is a deglobalization trend where supply chains are being reconfigured to friendshoring or nearshoring, then between these two things, we will have, and I'm convinced that we will have in India, a capex cycle that we've not had since many years, since more than a decade. In addition to this capex cycle, a necessary corollary will also be a credit expansion cycle. So when you have a capex super cycle along with a credit super cycle, you will have good times ahead of you, as I shared earlier.
Sridhar, a capex super cycle which Utpal spoke about and Hiren also spoke about, is that enough to drive growth and take care of the shocks which are coming from geopolitics or external shocks which are coming in?
No, I think from a macro standpoint, the government and Reserve Bank, whatever they have done, they've been quite phenomenal. But I think the challenge is that India is an importer of crude, and if the war had not happened, our own view was that FY27 would have been a great year because earnings were coming back. Only because of what is happening because of the war and because of the implications of that on inflation, and many companies will not be able to pass on the benefits, pass on the increased cost. We are seeing margins, we expect margin compression happening for the current year. And that is pushing down the earnings growth for India in general. But if you ask me that, is capex enough? No, consumption is the other big engine that our economy rests on. Exports is the other one. IT services facing its own set of challenges, but what we are seeing is that some part of it is being offset by the GCC revenues that we are seeing. So there is offsets at various places. But I would say it's a multiple, I mean, India is not just one theme, right? As Utpal was mentioning, there are multiple themes. You could find multiple sectors in India. So on a bottom-up basis, you'll always find themes to invest.
Hiren, 2025, we saw two policy decisions, one on tax front, one on indirect tax front, which was helping in consumption. This year, as Utpal mentioned, there are external policy tailwind which is coming in terms of rupee, then you have policy tailwind which is there. But even then, why isn't the market convinced about the growth narrative which is there? And why is the market worried about it?
Are you talking about economic growth? Or?
Economic and corporate growth.
Well, I mean, I think if you look at what happened in 2022 when the Russia-Ukraine war broke out, right? I think we had a similar geopolitical shock. We had an energy shock. We had a supply chain shock back then. And I think for a brief period, for about 2 quarters, we had a significant earnings slowdown, right? So I think that playbook is still very fresh in the minds of the investors. I think obviously the Q4 earnings were better than what most people expected, but I think somewhere at the back of the mind, the market believes that Q1 numbers will not be that great, right? And even I don't have a crystal ball, but I think it is fair to say that there will be some compression in margins. But I also believe that, and from what Utpal Bhai said, I think people forget that, a depreciation of the currency and a little bit of pickup in inflation is actually very good for corporate profitability. I think one of the problems of last financial year was that our nominal GDP was growing at single digits, high single digits, because inflation was very, very low. But I think a little bit of inflation is good. My sense is that this time, learning from the 2022 cycle, I think corporates are going to become much more smarter in terms of passing on the higher costs to the end consumer. Now, obviously, it will differ from sector to sector because it will depend on the competitive dynamics in each sector. But in general, my feeling is that this time we will not see the level of margin compression that we saw in 2022. I think people are far more prepared, and I think the entire ecosystem is prepared to absorb higher prices. If you see, one of the things, the narrative was that because of tariffs, US inflation will spike. But US inflation did not spike. It only spiked now because of the energy shock, right? The latest readings that came for US inflation was largely driven by energy prices. So my point is that because of an old playbook and correlations that are still fresh in the minds of investors, people feel कि earnings में बहुत बड़ा impact आएगा. I think the jury is yet out. My feeling is that we will be okay with earnings, and once the market is convinced about that, I think they will also respond.
I know Sridhar is a contrarian on inflation target, and he thinks that RBI is estimating too much of inflation, but it's not going to be, right?
Yeah, so my own view is that RBI's inflation target of 5.1, especially the Q3 of 5.9 is very high. What I think RBI is missing is that some part of the inflation last year also came because of gold and silver. Almost 60 basis points came because of gold and silver. This year, that is going to be more on the positive side. Plus, I'm not in the El Nino camp. I think this is a hoax we've seen many years. I've traveled to 5 states in the last 45 days. We've had pre-monsoon. I faced pre-monsoon showers in all the 5 states. And that impacts the food and vegetable prices to a large extent. So I'm not in the camp. I think RBI was wrong even last year. Their credibility on inflation projection hasn't been very good. I think they may end up being wrong even this year. And so I'm not in the camp that there needs to be a rate hike at all. Because to a large extent, the rate hike chatter was more because of the currency related issues. And that I think they have taken care of very well. And if inflation is going to be transient and it is closer to 4.5, there's no need for a rate hike. So that's my broad view on inflation and rate and how I see this.
Utpal, multiple tailwinds, you spoke about it, you articulated very well from the policy front, from the fiscal front, from the monetary front. We already have a developed economy like a EU already doing a hike. Do you think that we will go into that phase in India as well? Will there be a rate tightening cycle which will happen to control inflation? And if you go by what Sridhar has to say, it's not, inflation is not a worry.
I think there are strategic choices that are being made and articulated by both the government and RBI. The intent seems to be that they don't want to give a growth shock. We may be having an inflation shock. If you combine an inflation shock and a growth shock, you will trigger the economy going into a negative spiral. Therefore, I don't believe that RBI is going to hike rates. I think RBI has signaled that its priority is to protect the domestic growth, and which is why it has let the currency depreciate. And it is now dealing with the currency situation without using the blunt tool of rate hikes.
Interesting. Hiren, you briefly mentioned that you created an index for India AI, 12 stocks. People would like to know which are the 12 stocks in it.
The constituents.
Which are the 12 stocks? Well, I mean, they are essentially all beneficiaries of the AI capex that is happening.
That you told us,
right?
I mean, the question was on the names. You told us it was an AI stack. We know they're all beneficiaries.
No, I think they are fairly large cap stocks. So, companies like Hitachi, GE, ABB, Siemens Energy, Apar, Polycab, Blue Star. I mean, all these companies, Cummins, I mean, these companies all supply into the AI. Again, my idea was to demonstrate that there was this sense of complete helplessness which had gripped people. My point is that if you think hard enough, and if this is such a big global capex theme, there are still linkages around the world, right? And there is a way to profit from it. You know, I think if you look at the whole post-COVID shift from bank deposits to financial assets and, you know, equity markets and SIP, I mean, that was a big trend, right? And funnily enough, for a lot of people who love private banks, I would say that if over the last 3 years, instead of investing in HDFC Bank, if you invested in HDFC AMC, you would have made a 35% CAGR returns over 3 years versus minus 1.5% for HDFC Bank, right? So my point is that there is always a way to play and benefit from a trend if you think hard enough and creatively enough, right? So I think that we have our own version of AI which beat Max 7 plus NVIDIA put together, by the way.
A huge round of applause for that. The India AI stack that Hiren created with his team give better returns than Mag 7.
Yeah. Sridhar, look at what's happening in the IT services. I know a lot have been written about, and some people have also written off the IT services. Do you think there is money, smart money, which may go there, capital may be deployed there because they are traditional good businesses and they're agile to take care of the entire transition?
So I have to say that within our firm itself, we have differing views on this. So I am on the bearish camp. I've been bearish on the Indian IT sector for the last 2 years. And I'm not suggesting that these companies will close down or shut down or anything of that sort. It is just that they're getting into a low growth phase. And the starting point itself was very poor because they were trading at, say, 30 times the multiple. And on top of that, you have this whole AI-related bogey which has come in. My view is that Indian IT sector, especially at the bottom of the pyramid, in fact, Infosys in their balance sheet has given out some data about how the number of people below the 30 years of age has come down drastically. That's exactly what we were saying, that coding, which is a very easy task for AI to do, that is the first one to get disrupted. But it doesn't mean that these companies are going to die. It's just that their terminal value goes down. As a result, the valuation multiple that you give comes down. And the classic example I always give is the media sector. So you look at the media sector, say 7-8 years back, they were trading at 20-25 PE. And then you get all the OTT invasion that has happened. What has happened to these stocks is that they are now in single-digit PE. So the point I'm making is that they may continue to get derated. I don't completely agree with the previous panel where they felt that this is an opportunity, but different people have different views. My view is that the sector will continue to get derated and they will have low growth. Doesn't mean that, and some companies will disrupt themselves. So the point is that if you are able to disrupt yourself and change the way you're doing business, maybe they will emerge as winners. I'm not in a position to identify the winner right now. So my view is to stay away. But there are others in my office who think that this is a great opportunity because the dividend yields itself are very attractive.
You know, Utpal, all through what has happened in the last year and a half, and I was telling my colleagues also this, I was like, I wish Rakesh Jhunjhunwala was there because he would come out on TV and he would tell you as is. Even during the March lows, he would come out and call a spade a spade. You've been through so many cycles with him. If he were here in this room today, what would he be saying about where India stands and where India is in this global equity multi-asset race that we're in?
He would say, the mother of all bull markets is ahead of us. He would also say that your patience may be tested, but your conviction will be rewarded. This is a time, I think, to build on your conviction. And always in the past, we've seen that conviction is what works out for you.
So where is it that you have that maximum conviction in this market right now?
I would say financials would be the space where I would have maximum conviction. On the capex cycle end, as I talked about the capex cycle and the credit cycle, on the capex cycle end, the valuations are already very high. On the credit cycle side, I think valuations are very low. So we are in deep value territory, both for banks as well as for ID services. But I think the resurgence in the lending side will be far better. The impact on the monetary side will be far better. We've been in a situation where our nominal credit growth has been 12% for the last 2-3 years. We are just coming out of that. I think I can see a sustained credit cycle growth of between 15 and 18% for the next 3 years, at least. That makes the financials an attractive space for me.
That also means if credit growth is going to come up to 15 to 18%, then your corporate spending also, which is going to go up in that sense. And so what you spoke about, the capex super cycle and the growth, it's going to come back in earnings despite all challenges, Hiren?
Yeah, I think when I spoke to a couple of banks, they said that there's no better time than lending to corporates at this point in time, right? So to some extent, I agree that we are going to see a very good credit cycle over the medium term. However, I believe that the big defining story of this decade is going to be manufacturing for India. Banks, NBFCs, manufacturing. But I think the leadership in this cycle, in my view, will belong to manufacturing.
Well, gentlemen, we are at the end of the session. Thank you very much for joining us today and giving your insights on how capital is going to flow into various sectors and the tailwinds we have. Thank you very much.
Well, thank you so much for that masterclass in reading the market. Now, before we begin our next session, which is going to be another interesting session, I would like to request, ladies and gentlemen, to kindly come forward. Please, some of our front seats right here. Right. Please do take the chairs right ahead and, please join us for the next session. The front rows are for our speakers, but kindly please come forward from behind for our next exciting session. Right. So our next session is going to be very interesting about a lot of things that we have discussed and a lot more to discuss going forward. Jude?
Absolutely. In fact, it's extremely contextual in where we find ourselves in Shibani from a geopolitical standpoint. And the fact is, crude price shocks, currency swings, geopolitical tensions, rising global rates. The headwinds are coming in from every direction and all at once. But the fact remains that, at its latest policy meeting, the RBI has in fact trimmed its FY27 growth outlook by 30 basis points to 6.6%, while hiking its inflation forecast by 50 basis points to 5.1%. But the real question, Shibani, is how much of this can India actually absorb before it starts showing, and just where the cracks might seem to appear.
Indeed.
So to moderate our next discussion with the theme India, weathering the macro storm, I'd like to invite Sajid back on stage, who will be joined by ET Now's very own Harsh Satya. So if I could have Sajid and Harsh on stage, please, before I welcome our next star panel, starting with the one and only Ridham Desai, Managing Director and Chief Equity Strategist for India at Morgan Stanley, who will be joined by Gautam Chacharya, Managing Director for Global Markets at UBS India. Gentlemen, Sajid, Harsh, may we have you on stage, please?
And a huge round of applause, ladies and gentlemen, for the next set of panelists who are right up on the stage right now. Sajid and Harsh, over to you.
Thank you, Sumit. Thank you, Shibani. Hello, folks. I hope you guys are having a nice evening. Of course, two gentlemen next to me need no introduction, but the topic is going to be extremely engaging. It's an extremely uncertain world, right? And at this point, in terms of how we're set up with regard to the macro, it's going to be a fun discussion because there is so much uncertainty. So let me actually take a question with both of you, a question each. What is it that the market currently seems to be discounting, which is unfairly getting discounted by the market? What's the one or two key pieces which you're going to look back and say, this was just extremely obvious, and this is getting discounted currently? Ridham, first you.
It's a really hard question. So I think the conundrum that we are facing is that there is a view developing out there that AI is likely to reduce India's terminal growth rate. And equities is all about terminal. It's not about what growth comes in the next 4 quarters or 8 quarters. And indeed, if India's terminal growth rate has declined because of AI, then I think what is happening in the market right now is absolutely correct. So the contrast to that is that if India's terminal growth rate has not declined, then we are at one of the biggest buying moments of my life in the market. So I don't know if I answered your question, but that's the thing. Now, by the way, the answer to this is still not known.
You've inverted it, Ridham.
It will only unfold in the times to come. I can lay down paths which will cause AI to hurt India meaningfully, and I can also lay down a path where actually India is one of the biggest beneficiaries of AI. So depending on what happens, it's part dependent. I think if you ask me for my view, I'm in the second camp. So I think this is one of the most brilliant moments to buy stocks.
Gautam?
So I'll add to what Ridham said. The AI part I agree, and that's a debate which will play out over the years. But linked to that is also currency. Like if we talk to investors, suddenly after so many years, many investors have awakened that currency is a weak point for India. But is it a weak point for next 3 months, 6 months, or for next 3 to 5 years? So that's the other aspect I would think is mispriced.
But currency is something which has been there every year, right? Means you see at least 3 to 4% depreciation every year. Suddenly, it becomes the talking point for foreign investors as far as investment is concerned. Why is that, Ridham?
No. This is not normal. The real effective exchange rate right now is suggesting that the rupee is about 11% undervalued. In my career, it has been this undervalued only on 2 previous occasions. So it got undervalued like this in the 2008 global financial crisis, and it got undervalued actually a little bit more than this in 2013 during Fed taper tantrum. Right now, there's nothing like that happening on the planet. So this is absolutely unique in India's history for the currency to become this undervalued in what is, I would term as a pretty normal macro environment. Arguably, India's macro stability is the best it has been in 35 years, and yet the currency is so undervalued. So no, you're wrong. This is quite a unique situation which I have not experienced in my entire career. I think it's hugely favorable to equity market investors because an undervalued currency, and it's a point that I make very often. First Japan, then Korea, then China and Vietnam. How did they gain so much of terms of trade? It came from keeping their currency undervalued. So the undervalued currency drives transfer of terms of trade. So if you ask me, I think the next 12 months growth in India will shock you to the upside. This is not a normal thing. It's going to be actually a very powerful environment. Of course, there are risks, and we've been dealing with those risks over the last few months. There was a risk regarding the trade deal. There's a more recent risk on the Middle East conflict. But if these risks go past, the macro situation is very powerful for earnings.
But Ridham, at a time when there's an engineered slowdown of sorts because of crude, right? To a certain extent, there's an
In which part of the world?
It's not reflecting yet. But
America's economy is red hot. Inflation is red hot. Korea is red hot. India is red hot. In month of May, we had record sales in vehicles. We had record footfalls in retail. We had record power consumption. Where is the slowdown? I have not seen any slowdown anywhere. Seriously, मुझे बताओ कौन से slowdown की बात कर रहे हो आप?
No, I mean, the assumption is if crude stays...
The thing is, so the
assumption is if crude stays at 90 to 100.
If oil stays at 100, then we will slow down. But oil is not staying at 100.
Gautam,
but even between 80 and 90, we'll be able to absorb this?
See,
in terms of the growth that you're suggesting.
So one of the biggest achievements by India over the last 10 years has been a dramatic decline in the intensity of oil to GDP. So people are still stuck in the template of the preceding 20 years. They think oil matters. Oil does not matter. We import 1.7 billion barrels of oil net. $10 se badhta hai, so it is $17 billion. That's about 35 basis points of GDP. It will knock growth down by about 9 basis points. $20 average, 18 basis points. You will not be able to even see it. Some concomitant impact on inflation, which is not a bad thing because we were running too low on inflation. So oil is different. In 2008, sorry, just excuse me for a moment. In 2008, when oil went to $148 in the month of July, do you know what was the annualized oil import bill of India? 14% of GDP. 14%. Up to 4 पे भी नहीं पहुंच रहा है. So no, the oil equation is very different. Of course, we should worry about everything, but it is not going to create a problem for India's growth.
Gautam, if the macro situation is not bad as Ridham is saying, and with the data he's saying, then what's preventing foreign investors from investing in India?
So look, I would agree with Ridham on the macro part, by the way. Like, I think, look, even the most bearish person out there, and I'm not as bullish as Ridham is for the near term, but the most bearish person, I have not heard even one of them mention the word fragile, which is a very common term for India in 2013. So that's the context. Look, foreign investors, it's always many things. First of all, till a few months back, emerging markets were not the flavor. Today, all the money is going to tech, US, obviously. Look, a market like Korea has seen record selling by foreigners this year. Much, much more than selling in India. Double of that in India. Record selling. So look, foreign selling is one aspect. Now, from an India context, there are various narratives, anti-AI trade, valuations, growth. To me, it's simple. If growth recovers the way we are talking about it, it starts showing up in earnings, that will get the belief back. It's as simple as that. The positioning is now actually supportive. Unlike a year, 2 years back, the foreigners are not well positioned in India. So as soon as the growth starts printing, they will come back. But in the immediate term, 3-6 months, the global tech is still sucking in a lot of the foreign flows. That's the reality.
If you allow me, I'll just contribute to this. See, first quarter of this calendar, March ended, India did about 12% earnings growth, which was double of the previous quarter. So we doubled our earnings growth trajectory. It was very good from compared to what we've been doing over the last 6-7 quarters. US did 27%. Japan, bada thakela market hai, 33%. Taiwan, 45%. Korea, 170%. You look at consensus growth for all these markets, 4 which I give you, for the next 1 year. India, I mean, if I give you 5 stocks, And by the way, Korea trades at 7-8 times earnings, Taiwan in low double digit, and even the US trades at 20 times earnings. I gave you all these multiples and growth. Which stock will you buy? I mean, India will not feature in this list. The relative earnings growth picture is very poor for India because all these other markets, and the previous panel spoke about this, we are in a major capex boom and India पीछे से आ रहा है. So if you ask me, take a 3-4 year view because some of this will unwind. In fact, most of it will unwind. India will still have growth. So I did this calculation on all these markets on 2030 earnings. And I know people in this room will say 2030, but equities are a quintessential long duration asset class. If you're not here for 5 years, you should do fixed income. You should not do equities. India is the cheapest stock market in the world by some distance because Korean earnings would have sank by then. And Korea will look really expensive on 2030 earnings. Today it doesn't. Taiwan also, US also, not India.
आप बोल रहे 5 साल पहले का आगे का देखो वहां पर अर्निंग्स कम इंडिया की अर्निंग्स बेटर रहेंगी. That's what you're saying?
No. India's growth will sustain much longer than these countries. So on a near-term basis, as Gautam pointed out, we are paling in front of these markets for the growth that we are delivering. The absolute number is good, but the relative number is not. But that relative number becomes better and better for India as you go forward in time.
So then for the next year or two, Gautam, will Indian markets continue to remain a difficult place to be?
So look, from a market, again, there's a headline index level market and there's a broader market. Headline index market, I think 6 months, 12 months will still be range bound. I don't think there's material downside. We have seen Nifty, for example, bottoming out at 22,000 2-3 times already. To me, that's the clear bottom. But from a near-term trading perspective, it's still going to be range bound. Look, within the broader market, we've had bull markets even now, as we speak. The pockets where we are seeing bull markets. India is a bottom-up stock pickers market. So that will continue. I don't see that changing. For the market to really broaden out where Nifty breaks out of the range, and that's the definition of a bull market, to me, that's 6 to 12 months away. And part of the reason is not just the global foreign selling. To me, that's just a narrative rather than a big driver of markets in itself. Also locally, there's a huge pipeline of capital raising. So purely from a technical perspective, that's also going to be a drag on capital going to the markets. But beyond everything else, to me, it's a growth print. The day growth comes back to 15-20%, market will fly.
And Ridham, what's your take on this?
We will surprise to the upside.
Next 12 months?
Yeah. Major, see, I think Utpal spoke about this. There's a major capex cycle underway in India. We see the investment rate going all the way up to 37.5%. If it goes to 37.5 as I'm seeing it, corporate profit share in GDP will be 9. It's 5.5 today. Earnings growth will surprise big time to the upside. Kisi ke forecast mein ye hai hi nahi. And the markets will do very well in my view. Headline, broad, everything. So I don't worry about it. With regards to foreign portfolio selling, if the IPO cycle starts tomorrow, which is going to start next week, major buying will happen. Because they'll come to buy the primary issuances. So your FPI selling issue also will get resolved. See, it's a technical point. Every morning, domestic mutual funds and retail investors are standing at 9:15 with a bid. 100 million, 200 million, 300. Kisi ko to bechna padega. So foreigners are selling. When corporates come to give their equity, foreigners will stop selling. The relative growth narrative will still be against India, but foreigners will stop selling. So there is a technical point to this. We need IPOs. IPOs aayenge, foreigners will buy, markets will go up. Growth, I think, is going to looking really good. And the most important thing which I tell a lot of global investors is that India is chaotic. And growth only comes out of chaos. There is so much to fix. Like the announcement on Friday, which the market did not pay much attention to. But what we did in the bond market is seminal. I've been talking about this for 3 years, 4 years now. And this is going to create a massive inflow of capital into India in the next 12 months. The number runs into tens of billions of dollars. So your BOP problem is resolved with the action. One small action on Friday. Like this.
We're talking about the tax ordinance on FIs bonds. Into bonds, government bonds.
Yeah, and also the FCNR and, complemented with the ECB relaxation, all that. But the main thing was the bond thing. So little one announcement like that, we have 1,000 announcements in our back pocket to release. So if we want, we can just roll out these announcements and suddenly the sentiment will turn. So I wouldn't wait for that.
Should we?
Sorry?
Should we?
What?
Should we roll out all of those announcements?
They'll come. We have so much low-hanging fruit in this country because we have so much to fix that it is very easy to turn this thing around. So I'm not worried about this. I think if you're here for the medium term, there's a lot of money to be made. And the markets look reasonably valued with a lot of growth potential. So it shouldn't be a problem.
Gautam, Ridham says that no one is factoring in the kind of growth that's going to come in. Why do you think the street is not factoring that growth? Because it's there to see.
So look, markets always do look backwards. We say markets are forward-looking, but the near-term sentiment is influenced by what's happened last 6 months, 12 months. Okay? And the reality of high oil prices is a sentiment overhang, not to mention the currency part. Those are the things which are an overhang right now. And that's why I think next 6 to 12 months to me is still tricky and likely range-bound. But completely agree with Ridham if I'm taking a view beyond 1 year. Like the growth, it will come back. In fact, we had early signals of growth cycle, not just growth print, but a growth cycle coming in late last year, early this year. In fact, some pockets are still seeing that growth continue, including credit. But obviously that's been overwhelmed by the sentiment around Middle East, oil and currency. Now that's a question of time. And also question of how long this overhang continues because it has to be cleaned out. Like $100 oil, there is some stress. It's not a big balance sheet or floor issue for India now anymore, but there will be some stress because of that. That will take some cleaning out. But if oil goes to 150 for 3 months, 6 months, then we are talking of a different environment altogether. So at the margin, markets are still worried about what's happening in the Middle East at the margin. And that's also capping the near-term worry in markets.
So Ridham is not too worried about oil, but where would you be worried if oil were to go? 90, 100, you'd be okay with it?
Look, oil was around 70, 80 before Middle East happened. And no one talked about oil, right? So moving from 80, and Ridham made a good point about oil intensity has come down dramatically for India, which is still missed. And all of this again goes back to the point I mentioned. The most bearish person has not used the word fragile. That tells you a lot. So oil will be a worry only if it goes up 130, 150. That's when it's a worry. Again, and also for a period of time, not for 10 days or 15 days.
Can I just say something here? See, you tend to desire to simplify this oil. But it is not like that. What happens is there's a compounding effect of negative factors. So it starts with the fact that India's growth slowed down. Then India went into a situation where the US trade deal started mattering. On its own, the US trade deal was not a problem. We have $45 billion of net exports to America because a lot of things were anyway exempted. The ones that were subjected to the 50% tariff was only $45 billion. On its own, it will not matter, but there's a compounding effect. Then came the Middle East conflict. So these are layers and layers of negative news which then actually add up and make it a problem. So when I was answering your oil question, it was as a standalone factor. But when you combine with the other things that are underway, then suddenly it all becomes a bit of a challenge. So that is, I think, what you need to keep in mind.
Ridham, whenever a geopolitical shock comes in, we start comparing ourselves what happened in the last 2 decades or 3 decades. Do you think from a structural point of view, Indian economy has changed to manage this kind of geopolitical risk and the shocks?
Yeah, I already mentioned, so the sensitivity to oil is a lot lower than it was in the past.
Not just oil, but across, whether it's tariff or any other event that comes in.
No, so see, this is all a function of whether they happen together or they happen on an isolated basis. So none of these things matter on an isolated basis, but when they come together, they will hurt.
The other piece is whether the growth on the top line, which is the growth that comes through, actually comes through even on earnings or not. And last couple of years have disappointed. You said Q1, calendar year 2026, the earnings were extremely strong. Is that really the kicker in terms of the quarter? I mean, is Q1 CY26 the turning quarter, and will growth really sustain all through FY27 according to you?
See, if you go back in time, say 35 years, Indian companies have a phenomenal track record of converting revenue growth into earnings growth, much better than almost any other place on the planet. The problem with the previous 6 quarters was that there was no revenue growth. I think Hiren made that point about nominal growth being single digits. We need double-digit nominal growth, which will then drive double-digit revenue growth and drive double-digit earnings growth. So we are getting there. We have gone through a period of lowflation, which caused nominal growth to suffer, and we are exiting that period now.
And low risk that this won't happen. Low risk that this won't happen. It'll very likely happen according to you. The double-digit earning growth FY27 likely will get clocked.
Listen, I go wrong half the time, so you got to take everything with a pinch of salt. Okay, I'm not some crystal ball gazer who can see everything coming. This is all about risk reward.
Of course.
So I just think at ये भाव से
but high probability. High probability.
हम लोग सब भाव के खिलाड़ी हैं. Okay, भाव से काम करने का, भाव अच्छा लग रहा है लेने का. अभी what happens in the future we'll find out, but I don't think you can go wrong at the current prices. The opposite is the case when prices are too rich. Growth looks very good, but you'll go wrong because, you know, a small bit of bad news can cause returns to dwindle, which is like what we were in September 24.
Gautam, from an earnings point of view, do you think we are, narrowing ourselves to only the large caps, how they are growing, and not looking at the broader picture or a bigger picture of mid caps and small caps? Because if you look from a broader picture, the growth is much more better in that particular cohort as compared to a larger cap.
Absolutely. And again, that's the point about the broad market and narrow market, or the index level market. Look, the India's indices are weighted by financials, consumers, and IT. That's not where, at least for the last few quarters, and possibly for the next couple of quarters, where earnings growth are high teens. Now, there's a case for credit cycle picking up and financials delivering that, but the broader IT and consumer unlikely to go to high teens in a hurry. And that's why when we look at index level earnings, Nifty, etc., sometimes that's a drag both in absolute terms and relative to history and relative to other markets. But the broader markets, absolutely. And that's why we said that there are pockets of bull markets already where earnings growth are quite mouth-watering. Not just good, but mouth-watering.
Is there a large risk to earnings growth, FY27, FY28, Gautam? Growth, you seem to be largely in line with what Ridham seems to be saying, that growth is going to come through. But will that translate to earnings growth is really the question.
So the way I'll put it is FY27, the street printed earnings, there will be cuts because street has not cut yet. But markets and investors are already expecting that. While FY28, I think there will be upgrades on both sides.
From a macro point of view, Ridham, the mid cap space and the small cap space, which are growing at a much faster pace than the large caps, do you think, that space is now getting very attractive for foreign investors? Because even if you look at the MSCI index, the kind of coverage that small caps or mid caps used to get maybe 5 years ago, the number of index stocks in those have almost doubled there. So the search for alpha, the search for growth is something which the foreign investor will now look at those kind of mid caps and small caps rather than limiting themselves to large caps.
I can't make such sweeping statements because it all depends on mandates, depends on the size of capital you want to put to work, the wherewithal to do detailed research. So it's dependent on all these factors. There are a set of people who are able to do on the ground detailed research, have the patience to wait months to acquire stakes and can do small and mid caps. There are others, what I call tourist money, that wants to basically buy the momentum large cap names, quickly deploy capital and make their money and exit. So I don't think we can generalize. At a point in time, I think a few years ago, foreign investors owned 1,200 companies in India in varying sizes. So it's not like they are averse to going down the cap curve, but it's not a general thing that we can say about the average FPI, for example.
And because you spoke about the fact that if IPOs begin, you'll see FPI flows coming back in a big way. At that time, is it fair to say that you'll have a lot of primary FPI flows, but in the secondary market you'll still have profit booking from the foreign investors?
See, again, we didn't actually discuss this in greater detail. there is a plumbing issue. The plumbing issue is that India's weight in the index continues to fall because it continues to underperform. So back in September 24, we were nearly 22% of the EM index. We're now down to under 12. And the fact is that almost 50% of the money managed in the world is passive. So it just reflects index weights. So as your index weight falls, it has to sell. So today India underperforms, next day again it has to sell. Because they come to sell, it underperforms again. It's a vicious circle. We experienced the opposite of that in 24. Because the markets were doing extremely well, passive money had to keep buying. And that is why you get these extremes in markets these days, both to the upside and to the downside. So something breaks this and then the plumbing turns. So that is another aspect about the FPI selling, because Gautam made a very important point which I don't think you explored, which is that the Korean markets have seen double the amount of selling that India has seen year to date from foreigners, and yet the Korean markets are like this. So I am actually, at the end of the day, if you have traded stocks, you will know one simple thing. The net flow is zero every single day. So this massive discussion about flow and stock market returns is so misplaced. The only reason why FPI matters is because they influence my BOP. Not because they're going to change share prices. Share prices, Vijay Bhai is going to change. Okay, so when he comes in to bid, nobody can stand there and sell the stock enough to take away the power of his bid. What moves stocks is the force of the bid or the force of the offer. Not who is buying and whether foreigners are buying or selling. It is not material. ज़्यादा discussion हो रहा है इस पे. हाँ, BOP पे बात करते हैं ना, but BOP तो turn मार रहा है अभी.
और इस साल पॉजिटिव रहेगा बीओपी बिकॉज एफसीएनआर भी आ रहा है और बॉन्ड फ्लोज भी आएंगे.
The likelihood is that we will have a positive BOP, and this quarter will bear evidence. It's going to come very soon. We'll know in the next 30-35 days. But I think we are doing okay on BOP now.
Worst for the rupee is over. I'll ask each of you. Worst for the rupee is over. Gautam first.
I would think so. Absolutely.
Ridham?
So I think the rupee is set to appreciate violently.
Violently मतलब कितना?
Just the way it
He's not willing to put a percentage to it, but
violently appreciate.
नहीं, अंडर वैल्यू भी बोला है और अप्रिशिएट वायलेंटली भी होगा, तो कितना जाएगा?
अंडर वैल्यूड है इसलिए तो अप्रिशिएट होता है ना.
कितना तक जाएगा?
No, I'm not going to put it. I'm not going to put a number. I'm not a rupee expert.
Gautam?
No, like rupee is not just about rupee, right? It's also about what happens with dollar and all that. So,
okay, let's come to the moot point. So clearly, we're at the bottom end of the cycle. That seems to be the consensus on this podium for the moment, last half hour. What is it that looks attractive from a risk-reward perspective? Ridham, what should an investor go out and buy right now? 1 year perspective.
I think Utpal said it, financials, both large, mid and small. I think it's the easy picking. Don't have to think much. Valuations are good. Growth is there.
That's an easy answer. That's an easy answer.
No, that's the easy picking. If you're not lazy and if you want to do a lot of work, then I think there are tons of mid and small cap stocks which trade at sub one-time sales, are actually very decent businesses. The businesses are in great shape, balance sheets are in great shape, just the valuations are, but there's a lot of work to be done then. Then you have to do a lot of mehnat. If you're willing to do that mehnat, there's a lot of money to be made in India.
Gautam?
so look, financials is obviously the easiest one, and not just because of valuation, but also because this cycle of growth recovery will be accompanied by a credit cycle, a proper credit cycle, which means even the private financials which have been struggling with headline growth will see much higher growth than what the markets are looking at. So it's not just a valuation argument. There should be actually high growth rates coming back. Look, beyond financials and mid-caps is a very, very broad world, but energy, and specifically the renewable energy piece and the entire ecosystem around that. Data center is a big thematic, but boils down to, again, energy and power T&D, where Indian companies can benefit. And finally, pockets of consumption. Like, I think that's one area where there's a lot of pessimism. Estimates are quite bearish. And where the right mix of growth and inflation, I think the building blocks are in place over the next quarter or two where they can surprise.
But if I may add some subsectors because I didn't do that. So auto parts, retail, then I think industrial equipment, but not necessarily just energy, semiconductors. I think general industrial equipment, real estate, I think construction. These companies, I think, are set for very good months ahead.
You said real estate, which hasn't done well.
Yeah, it's going to turn now.
Okay. And Gautam, I'll just push you a little bit further with regard to sectors. So consumption, you know, some of the valuations trade at 30, 40, 50 times multiples. They're holding companies in counterpart countries, Korea and the like. They trade at a fraction of that multiple, right? How do you justify that in an environment like this?
Look, you can't justify based on fundamentals, obviously, but that's the market structure, and that won't change.
I'll tell you, see, the reason why investors have flocked to India is because this country is obsessed with return on capital. जो बाहर ठेले वाला है ना, उसको 15% आज नहीं मिला ना, तो दुकान बंद कर देता है. Nowhere on the planet, other than from United States of America, is there so much obsession with return on capital. Stock returns only come from return on capital. They don't come from growth. If you grow without return on capital like China has done, you don't make money in the stock markets. You show me 20-year, 30-year compounded return in China. नहीं मिलेगा. China has done very well on GDP growth, but no focus on the balance sheet. Stock market returns are made from the balance sheet, not from P&L.
Point well taken.
Yeah.
The consensus right now seems to be financials. And my simple guess would be lenders. The eternal debate seems to be private versus PSU. Where do both of you all stack up on that?
I think the broader financial space which will do well. It's not the time to choose.
Okay.
I think this comparison is not valid. What you have to do is buy the lenders that are aggressive, willing to take risk, and are trading okay. Valuations, I think, are almost fine everywhere. So you want to look for people who are willing to take risk. Now is the time to take risk and lend. If you're not going to take risk, then I don't think it's worthwhile.
So faster growth. Faster growth.
Yeah. If you take risk, you will grow faster. But it's a good time of the cycle to take. It's a good time of the cycle to take risk.
Okay.
There will be a time when, of course, this will not be the case, but we are not there as yet.
Okay. Closing thoughts. Biggest risk that India faces, maybe over the next year and a half. What could surprise on the downside? We've covered pretty much all the upsides now. Let's try and.
Downside is the oil shock, not current oil.
So
Real shock.
above 120, above 130.
At least above 100, yeah.
Okay. Ridham?
See, I worry a lot about where we are in the world. The overall global debt is elevated and the world is aging. We are masking the structural problem on the planet with a massive AI cycle, capex cycle. At any point in time, if that comes to the forefront, it will create a problem. Now, for a country like India that is seeking to increase its trade share in the world, both manufactured as well as services, such a global problem will hurt us. And it's not a question of next 1 year, 2 years. This can happen at any point in time, so it's my biggest worry.
All right. Everyone, please, if I can request you for an ovation. We've had a fantastic conversation. Ridham, who's synonymous with Morgan Stanley, and Gautam Chowcharia of UBS. It's a complete pleasure hosting this. Thank you so much for being here.
Thank you.
Well, Ridham and Gautam, thank you so very much for setting those ground realities straight on the macro situation that's staring us right in the face. And this conversation, of course, coming at a time when we are at a crucial inflection point with regard to the markets and the geopolitical context that surrounds us, Shivani.
Indeed, Jude. Now, every investor dreams of spotting the one stock that multiplies many times over. Very few have the conviction to buy it early and the patience to hold on to it. Our next guest has built a career on exactly that. He joins us for some of the timeless investing wisdom on the topic, finding the next multi-bagger opportunities. First up, I would like to call upon stage Aisha Faridi and Sajid, who will be in conversation with the dynamic Vijay Kedia. He's a private investor.
Give it up, guys, for Vijay Kedia, Sajid and Aisha, who will be joining us on stage in just a moment.
A huge round of applause, and I'm hoping Mr. Kedia to again sing for us this time round again.
Well, we let him decide on that even as that session pans out.
When it's a Friday evening, who better than Vijay Kedia to join ET Now 17th birthday celebrations? So shall we start with happy birthday or a ET Now song or a Rise with India, which is our theme, that song or something for the investors here? Musical शुरुआत होनी चाहिए ना?
किससे?
किसी से भी.
तो आज आप शुरुआत करो आज किसी गाने से. हाँ, तो ये थोड़ा टेबल चेंज.
Hall खाली हो जाएगा. So I'll leave that for the best. कुछ तो some musical शुरुआत, माहौल बनाना, हाँ. Yes, like Sajid said, माहौल बनाना.
So now actually let me recite a song which I had written 7 years back, which is a all-weather song applicable in every kind of market. You know, so that actually gives us the clear picture what is happening in the market at any given time. So I can recite a few lines of that. So it's like this, that kabhi DI, kabhi FI, inflation, kabhi tel, kabhi dollar, kabhi barish, in sabka hai ye khel.
विजय गा के.
अरे गा के कहाँ, तो लास्ट का 4 लाइन गाता हूँ, पहले इसको कंप्लीट करता हूँ. तो कभी DI, कभी FI, इन्फ्लेशन, कभी तेल, कभी डॉलर, कभी बारिश, इन सबका है ये खेल. प्रॉब्लम्स के हैं कई नाम यहाँ, जरा हटके जरा बच के शॉर्ट टर्म में मेरी जान. ऐ दिल है मुश्किल कमाना यहाँ, यदि थोड़ा हटके जरा बच के शॉर्ट टर्म में मेरी जान. और उसका दूसरा स्टेंजा ये है, कभी मैक्रो, कभी माइक्रो, कभी स्लो डाउन, कभी स्केल, कभी यूएस, कभी चाइना, कभी झगड़ा, कभी मेल. टेंशन के हैं कई नाम यहाँ, जरा हटके जरा बच के ट्रेडिंग में मेरी जान. और लास्ट का ये है, कभी टेंशन, कभी फियर, कभी क्राइसिस की धुन, झेल सकता नहीं इनको तो म्यूचुअल फंड चुन. इन्वेस्टमेंट के हैं कई नाम यहाँ, जरा हटके जरा बच के शॉर्ट टर्म में मेरी जान. ए दिल है सिंपल कमाना यहाँ, यदि लॉन्ग टर्म बस लॉन्ग टर्म, ओनली लॉन्ग टर्म मेरी जान.
Okay, we'll get you to add the musical notes later. But since you did talk about the conviction in mutual funds, कि ये noise, बारिश, झगड़ा, झंझट सब तो चलते रहेंगे. What should retail investors be doing right now?
Investors should?
What should they do right now in this market? जहाँ इतना noise है, इतना volatility है, what is the future for investors?
Now you see, this is what is every bull market, every euphoria market turns into a crisis. This is what data suggests. This is what we have seen in the market. If you see the 50 years history, you know, so every crisis will turn into an opportunity. And this is what happened. Between 2021 and 2024, people made a lot of money. Not in percentage term, but they multiplied their money. So now this is the side effect of, जिसको बोलते हैं प्यार के side effect है. तो ये प्यार के side effect है भाई. तो ये भाई ठीक है, it's going on for 2 years, for last 2 years. But I think, like everybody is also saying, that table is going to turn, you know. Things are going to change. But one thing what I feel that investors should keep it in mind, that whichever stocks are performed in the past may not perform in the future. Whichever shares have multiplied in the last bull market may not participate in the next bull market. So it is a rotation theme. So theme is concerned, it is on a rotational basis. So now you have to do, you know, your homework, and whatever has given you money, not necessarily that is going to give you money. So you have to be have money. You have to be careful in this market. But ultimately, I think people will make big money if you can sense what is the emerging theme in this market. Then you will make big money.
So where are you sensing the next emerging theme? Considering even Ridham Desai just said कि पैसे बनाने हैं तो विजय केडिया से पूछो कहाँ स्टॉक में डालना है.
नहीं, वो तो उनको जवाब नहीं देना था इसलिए मेरे पे टाल दिया, तो अलग बात है. So मेरे को I think the next theme for next 10 years theme I've given acronym to it. It is like RISE, you know. So this RISE theme is going to make money for investors. And in this RISE, I will tell you that R stands for renewable. So renewable and energy transition. Because I feel like what oxygen is important to the body, same way energy is important to a nation. You know, energy runs a nation, like oxygen runs us. So I think this is a new theme, maybe because of AI and data center, or whatever. So many people have spoken about that. So I think this R stands for renewable energy, renewable and energy transition. That should do well. And I stands for infrastructure and logistics. So this is, I think this is again a sunrise theme. And S is for security. It could be defense and it could be cyber security, because defense security also requires cyber security. So that is going to be a play out. That is going to become a very big theme. You know, and what I feel that nowadays things have become so much on depending on data, a nation depending so much on data, that you don't have to, even if you attack, like suppose, I had said somewhere else, like if I suppose attack your data center through cyber security, breach of cyber security, your entire system will become, you know, stranded. So this is what S stands for security and cyber security, and E stands for emerging technology. So whether it is either AI or a data center or EV or payment gateway or whatsoever. So this emerging technology. So if I think this is what I am focusing upon, if investors focus on this theme, they should make money in next 10 years.
आपने बोला renewables, infra, security और emerging technologies. Securities का अगर हम देखें तो डिफेंस में काफ़ी उछाल आया है स्टॉक्स में, वहाँ पर भी emerging technologies काफ़ी आ रही हैं. तो आपको क्या दिख रहा है, किस तरह की टेक्नोलॉजीज दिख रही है और भारत में कौन कौन से कंपनीज हैं जो कर रही हैं?
So इसमें डिफेंस का तो सब everybody knows about defense.
वो तो
It's an old story.
PSU पैक हो गया वो. हाँ.
Yeah, and P wise also it's very expensive discount wise. So I'm not investing into that kind of security. But I've invested in few cyber securities companies. So those are newly listed in the market, you know. So I'm invested in all of them. Whatever, there are 4 companies listed, I'm invested. But there is a caveat. One should remember that things are changing, technology is changing so fast. You know, you never know. Whatever we feel that today is the 100% guaranteed. There is nothing called guaranteed in this market. Yeah. So today we feel that it could make money for us. Maybe tomorrow technology changes. So that is why you have to be on your toes every given time. So this is what I mean. Yeah.
Securities में भी warfare change हो चुका है. आप देखते हैं कि we used to have big missiles, high cost missiles. Now it's a drone system, low cost, high impact security. Cyber security, you mentioned that's from the web point of view. But from the low cost, high impact, you are seeing opportunities in some small and mid cap companies which are working really well in that space?
नहीं, इसमें मैं एक बात ये बताना चाहूंगा, इसमें ज्यादातर जो शेयर्स हैं, जो जैसे आप नाम लीजिए, जैसे साइबर सिक्योरिटी में भी जो भी, ये सारे शेयर्स अनलिस्टेड कैटेगरी के अंदर में, ये लिस्टेड
कभी ना कभी तो मार्केट में आएंगे.
हाँ, वो आएंगे. तो आपको आइदर यू इन्वेस्ट इन अनलिस्टेड कंपनीज और यू वेट फॉर देम टू गेट लिस्टेड. तो डिफेंस के अंदर में भी ऐसा ही हो रहा है. स्टार्टअप में इतने काम हो रहे हैं. अभी जैसे ब्रह्मोस की आपने बात किया, कोई मिसाइल विसाइल का कोई बात किया, वो भी कोई बैंगलोर की या चेन्नई की कोई स्टार्टअप है जो उसमें इन्वॉल्व है. तो ये टेक्नोलॉजी इतनी तेजी से चेंज हो रही है इसके अंदर में. तो ये जो नया स्पेस जो है स्टार्टअप्स का, ये इट इज गोइंग टू प्ले अ वाइटल रोल. तो उसके अंदर में लेकिन कॉमन इन्वेस्टर की वहां पर पहुंच नहीं है, बिकॉज दे डोंट अंडरस्टैंड विच इज वर्थ इन्वेस्टिंग, विच इज नॉट वर्थ इन्वेस्टिंग. क्योंकि इसमें से 10 में से एक कंपनी है जो सक्सेस होगी, 9 कंपनी वो फेल हो जाएगी. सो ये थोड़ा ट्रिकी है. तो इसके बोल के बेटर है कि आप जो लिस्टेड कंपनी है जिसका कोई ट्रैक रिकॉर्ड है, वो कभी मार्केट गिरता है उसके अंदर में अगर आपको लो पी में अगर मिलता है तो आपको उसमें इन्वेस्ट करना चाहिए, विच इज द सेफर रूट.
और इंफ्रा में?
इंफ्रा में तो बहुत कंपनियां, इतनी इंफ्रा कंपनियां हैं, वो सब ऊपर से 1/3 भाव में मिल रही है। आप जो भी आप 5, 7, 10 आप नाम लेंगे, लार्सन को छोड़ दीजिए, लेकिन उसके अलावा लार्सन के अलावा जो बाकी नीचे की कंपनी है वो सब 1/3 और हाफ होता है, 40, 60, 70% डिस्काउंट में मिल रही है। और सबके आप पास देखिए, एवरी वीक यू विल सी ऑन और योर टीवी चैनल कि इस कंपनी को 2000 करोड़ का ऑर्डर मिल गया, इसको 500 करोड़ का मिल गया, 700 करोड़ का ऑर्डर मिल गया। तो ये इनका ऑर्डर बुक बनते जा रहे हैं इनको, और अभी एग्जीक्यूट करने वाले बहुत कम है। जो पहले इंफ्रा के अंदर में समझिए 100-150 कंपनी होगी एग्जीक्यूट करने वाली, अभी अच्छी एग्जीक्यूट करने वाली लिस्टेड स्पेस में तो 4-5 ही कंपनियां। तो इस बोलकर ये पूरा ट्रांसफॉर्मेशन होगा, बिना इंफ्रास्ट्रक्चर के इंडिया कुछ होने वाला भी नहीं है, बिकॉज स्टिल वी आर फार बिहाइंड। तो इसमें जो लिस्टेड है उसके अंदर में शेयर सस्ते, उसमें दिमाग लगाना चाहिए।
So Vijay, one is the rise theme, but you are an investor. I remember 3 or 4 years back, you were the first one who said, "Ki I am buying China." Right? You were the first one in the March lows who said, "Ki buy the market now." You know, you've been very ahead of the herd, and you've taken those contra bottom-up bets. What is that large, sizable bet that you can spot in this market right now and globally? Let me not just, stick it to India.
So, ahead of the curve में तो ये ऐसा है कि जब लाइन घूमती है तो आप सबसे पीछे रह जाते हो, तो वो तो टेम्परेरी है, वो ahead of the curve का बात है। और so far Chinese is concerned, yes, I had bought some ETF, that your Hong Kong stock ETF was, it's listed here in NSE and all that. I had bought that, but last week I exited because I found maybe that Chinese economy may do well, but maybe Chinese stock, although I got 50% return in 1.5 or maybe 2 years time, so that is okay. So, but I have sold all my Chinese ETF and all. Now again I'm focusing on Indian market. So this is one change, and meaningful stake. I bought some stake in one solar company, so it's integrated solar plant. I have taken some percentage into that company. So I'm bullish on solar, as I said.
For the seasoned investor, and perhaps that's also a reason why the market was flat, because there was so much money last year at least, which was going in private equity and which was going a lot in IPOs as well. Till, of course, the March fall happened. Within the private equity space, because you are a large investor there, where do you find these big sizable opportunities right now?
So I am focusing on deep tech companies, like again, of course, cyber security companies, and plus related to power. Whatever the rise theme, actually, I said, I am focusing on that rise theme, and mainly into last week only I invested in one company which is into solar pump and all, rooftop solar and solar pumps and load, which is like it is PM का भी है ना, PM कुसुम योजना, PM सूर्य घर एंड ऑल दोस थिंग्स, वो सब जो गवर्नमेंट का जिधर फोकस है, तो मेरा फोकस उधर है जिधर गवर्नमेंट का फोकस है। सिंपल एक बात है, उस पे प्लसेस भी है माइनसेस भी है उसके अंदर में, बिकॉज अल्टीमेटली दे आर डिपेंडेंट ऑन गवर्नमेंट. So people don't like to be dependent. All these infrastructure stocks, as you said, they couldn't do well in last 2-3 years because they were fully dependent on government money, and government was busy in distributing freebies and all. So all like free electricity, free ye yojana, bhain yojana, bhai yojana, sab bhanji yojana. So all these actually couldn't get money from the government. That is why they suffered. तो लेकिन इसके अंदर में गवर्नमेंट हैज गिवन प्रायोरिटी कि उनका एक टारगेट है कि हाँ भाई ये सोलर पंप और ये उनको प्रायोरिटी के अंदर में लगाने का है. तो आई हैव इन्वेस्टेड इन विच इज एट मैंने अनलिस्टेड स्पेस. सो दिस इज व्हाट द लेटेस्ट आई डिड.
विजय, रिटेल इन्वेस्टर को पिछले 2 साल में अगर हम देखें तो उतना रिटर्न नहीं मिला है, पर आप जैसे कहते हैं कि लॉन्ग टर्म के लिए इन्वेस्ट करना चाहिए, तो वहाँ पर रिटेल इन्वेस्टर्स को कितना पेशेंस रखना पड़ेगा?
नहीं, शेयर बाजार तो भाई पेशेंस का ही गेम है. यहाँ पे तो यहाँ तो 3 चीज बहुत जरूरी है, नॉलेज, करेज एंड पेशेंस. और पेशेंस आपके हाथ में है नहीं. जब तक वो मेरा एक गाना है कि बोले ये बॉटम है, इस बॉटम का नहीं है कुछ पता.
विजय, गाने हमें ऐसे नहीं समझ आते हैं. आई मीन यू हैव टू पुट अ म्यूजिकल नोट टू इट.
कोई भी समझ ना पाया, नहीं कोई पाएगा, जब तक रहेगा लेते नया लो बनाएगा. गिर जाएगा बिक जाएगा वहीं पे तो बॉटम है, ये बॉटम है, इस बॉटम का नहीं है, नहीं है, नहीं है कुछ पता, ये एक भ्रम है। तो धीरज की यहाँ पर वो टेस्टिंग, पेशेंस का यहाँ पर जो आपका टेस्टिंग होने वाला है यहाँ पे। तो जब तक आप हार नहीं मानोगे तब तक मार्केट गिरता रहेगा, तब तक आपको वो धीरज को टेस्ट करेगा। जिस दिन आपने बोला अरे भाई और मेरे से नहीं देखा जाएगा, वहीं पर बॉटम बनता है। ये इतिहास बताता है यहाँ पे।
क्या आपको लगता है बॉटम हो गया?
नहीं, ये बोलना मुश्किल है। और मैं कभी भी इंडेक्स के बॉटम को नहीं देखता हूँ। एक बात मैं आपको बताना चाहता हूँ, मैं कभी भी इंडेक्स के बॉटम को कभी भी टारगेट नहीं करता हूँ। इंडेक्स का बॉटम अपना अलग चाल चलता है। एक बात आप समझिए कि 2003 से 7 के बीच में जो इतना बड़ा हिस्टोरिकल तेजी आया, उसके बाद में 2008 में मार्केट क्रैश हुआ। लेकिन 2008 में जो मार्केट क्रैश हुआ, 2008 से 14 के बीच में इंडेक्स ने नया हाई नहीं दिखाया। इंडेक्स इधर ही घूमता रह गया। लेकिन कई शेयर ऐसे हैं जो 2008 और 14 के बीच में मल्टी बैगर हुए, 10 गुना 20 गुना। मेरे 3 शेयर 100 गुना हुए वहाँ 2008 के बाद में 2016-17 तक, 100 टाइम्स। तो वो मेरे को ये समझ में आ गया मेरे को कि इंडेक्स को देखकर मेरे को इन्वेस्ट नहीं करने का। इंडेक्स एक कंफर्टिंग फैक्टर है आपको कि हाँ भाई इंडेक्स ऊंचा है तो मार्केट अच्छा है, इकोनॉमी अच्छा है। अभी उसने क्या बताया उन्होंने कि मई का जो सेल्स आया उसमें गाड़ियों का सेल्स ऑल टाइम हाई है, इसका सेल्स ऑल टाइम हाई है, उसका सेल्स ऑल टाइम हाई है। तो ये अपने को बताता है इंडेक्स पूरा आपको ठीक, आपको मार्केट का जो है वो रूपरेखा आपको नहीं बताता है। तो मैं इंडेक्स पे फोकस नहीं करता हूँ। मैं बॉटम अप अप्रोच है, इंडिविजुअल स्टॉक, इंडिविजुअल सेक्टर, उस पर मैं फोकस करता हूँ। और ये ध्यान में ये रखता हूँ कि ये इंडेक्स अगर पड़ा भी रह जाए, मार्केट क्रैश नहीं हो, मार्केट का सेंटीमेंट अगर ठीक ठाक भी हो, साइडवेज भी हो, तो भी शायद ये अच्छा रिटर्न देगा।
तो विजय, आपने बोला कि आपने हैंगसेंग ETF एग्जिट कर दिया अभी अपने पोजीशंस। Where is it that you've increased allocation, say in the last 6 months?
So as I said, again that rise that I have bought, I think 2 companies into solar space and 1 company that into pump and rooftop solar. So that is also again solar. So I've increased my investment in this, yeah. And plus I have bought 1 infra company, some shares in infra companies also I have bought. And plus I'm looking for unlisted space now. I'm very active in unlisted space.
ऐसा क्यों? लिस्टेड स्पेस में आपको वैल्यूएशन ज्यादा दिखती है या अनलिस्टेड स्पेस में अपॉर्चुनिटी और रिटर्न्स आगे जाके ज्यादा दिखते हैं?
नहीं, उसमें क्या होता है अनलिस्टेड स्पेस में, एक तो क्या होता है आपको क्वांटिटी मिल जाती है आपको, बाकी मिड कैप तो पूरा इलिक्विड है। इसके अंदर में आपको घुसना आपकी मर्जी से, निकलना आपके हाथ में है नहीं। तो वो तो भगवान के हाथ में है कि आप कब निकलोगे। लिस्टेड स्पेस अनलिस्टेड में उससे भी ज्यादा है, वहां पैसा 0 हो सकता है या मल्टीप्लाई हो सकता है उसके अंदर में। लेकिन वहां पर एक तो मेरे को क्वांटिटी मिल जाती है, 5% 10% कंपनी में शेयर्स मिल जाता है। और वैल्यूएशन मैं उसके अंदर भी ऐसी कंपनी में इन्वेस्ट करता हूं जो मेरे को 5 या 6 के पी में मिलती है, जो आकर मेरे को नैरेटिव सुनाता है ना कि सर मैं IIM से आया हूँ, मैं IIT से आया हूँ और एनवीडिया का इतना बड़ा मार्केट कैप है, इसका इतना बड़ा मार्केट कैप है। जो अपने आप को उससे कंपैरिजन करता है, मैं उससे मीटिंग भी नहीं करता हूँ। मैं बोलता है टाइम वेस्ट करके फायदा नहीं है भैया। अपने को एनवीडिया वाला, अपने को किधर एनवीडिया वाले से मिल रहा है, एनवीडिया बनने जा रहा है अपने को। तो इस बोलकर तो मेरा उसमें भी एकदम पक्का है कि मेरे को अगर मेरे को वैल्यूएशन चीप मिलेगा तो मैं उसमें इन्वेस्ट करूंगा, नहीं तो बस दूर से ही करके सलाम।
क्या आपको बहुत सारी कंपनीज और नए एंटरप्रेन्योर्स मिलते हैं जो फर्स्ट टाइम एंटरप्रेन्योर्स हैं और आइडियाज़ के साथ हैं पर फंडिंग नहीं है उनको? क्योंकि आपने जैसे कहा जो आपके पास IIM और IIT आते हैं वो वैल्यूएशन भी हाई मांगते हैं, पर जो नेचुरल या ग्राउंड आप एंटरप्रेन्योर्स हैं वो धंधा भी जानते हैं और रिटर्न लेना भी जानते हैं। धंधा भी जानते हैं और रिटर्न लेकर आना भी जानते हैं। तो आप उन कंपनी में ज्यादा इन्वेस्ट करते हैं या
डू यू प्रेफर दोज एज अपोज टू हार्वर्ड MBAs? द ग्राउंड अप वाले जो हैं, यू नो, स्टोरीज, यू प्रेफर दोज एज अपोज टू the IITs and Harvards which you don't entertain?
Of course, उसमें एजुकेशन तो जरूरी है ही है इसके अंदर में, उसमें तो कोई उसके अंदर में बात नहीं। मैंने कोई IIT IIM के लिए नहीं बोला, लेकिन ये नहीं कि हर आदमी बड़ा एंटरप्रेन्योर बन जाता है IIT से निकल कर। उसमें भी आपको चुनना पड़ेगा ना कि आपको अल्टीमेटली कोल माइंस में से ही आपको हीरा निकालना पड़ेगा ना आपको। तो यहाँ पे सब आकर खाली दैट इज नॉट द ओनली क्राइटेरिया दैट यू हैव कम फ्रॉम IIT और IIM, दैट डजंट मीन दैट आई एम गोइंग टू गिव यू मनी। व्हाट इज योर विजन एंड हाउ मच पेन यू कैन बेयर, दैट इज वेरी इंपॉर्टेंट। क्योंकि स्टार्टअप के अंदर में आप जो भी आप आइडिया ले, और मैं कोई एकदम आइडिया स्टेज पे इन्वेस्ट नहीं करता हूँ। जब वो कंपनी 3 साल 4 साल ऑलरेडी उसने पापड़ बेल लिए हैं, उतार चढ़ाव देख लिया है, 2-3 बार फेल होते होते बच गया है, उसने सीख लिया है, समझो 3, 4, 5 साल से, तब मैं उसमें इन्वेस्ट करता हूँ। मैं आइडिया के स्टेज पे इन्वेस्ट नहीं करता हूँ। एक प्रूवन ट्रैक रिकॉर्ड है कंपनी का, ऑलरेडी ऑर्डर इन हैंड है, ऑलरेडी रेवेन्यू है, ऑलरेडी प्रॉफिट के अंदर में है, लेकिन उसको ग्रोथ कैपिटल चाहिए। उसको खाली अपने आइडिया के ऊपर में पैसा नहीं चाहिए। तो ऐसे स्टेज पे और ऐसी कंपनियों में मैं इन्वेस्ट करता हूँ, खाली नैरेटिव पे, खाली स्टोरी पर इन्वेस्ट नहीं करता हूँ।
तो विजय, आज ET Now का 17th बर्थडे है अगले हफ्ते। इन द लास्ट 17 years that you have tracked markets, सबसे बड़ी लर्निंग क्या हुई आपकी?
सबसे बड़ी लर्निंग स्टॉक मार्केट में वो हमेशा यही है कि ये बुल मार्केट बेयर मार्केट आते जाते रहता है। तो इसके अंदर में पैसा वही कमाता है जो पिच पे खड़ा रहता है। मैं कई बार और कई जगह आपके भी चैनल में बोल चुका हूं कि पिच पे जो आदमी खड़ा रहेगा ना, वो आदमी पैसा कमाएगा। अगर आप आउट होकर पेविलियन में अगर चले गए और बाद में 9 बॉल अगर आई, तो आपके बाद में जो आदमी खेलने के लिए आया वो उस पर छक्का मारेगा, आपका करियर खत्म हो गया, माने आपका वो वाला इनिंग खत्म हो गया। तो यहाँ पर जब आपको लग रहा है कि पिच अच्छी नहीं है, जब आपको लग रहा है कि बॉल बहुत खराब आ रही है, आप खेल नहीं पा रहे हो, आप उसको चुपचाप डिफेंसिव खेलते जाओ, उस पर अपनी पिच को मत छोड़ो। शेयर बाजार भी हमको यही दिखाता है, जब प्रॉब्लम है, जब वॉर है, जब इन्फ्लेशन है, जब अभी ये क्रूड है, ये है वो, आप चुपचाप खड़े रहिए बगुले के जैसे, कि जब मछली आएगी तो मैं उसको मार कर उसको मैं ले लिया, नहीं तो मैं चुपचाप बगुला भगत के जैसे मैं बैठा रह गया तालाब के अंदर में बिना हलचल किए बिना। तो ये मैं यही समझा यहाँ पर। और जो खड़ा रहता है, जो बेयर मार्केट सबसे बड़ा टीचर है स्टॉक मार्केट का, सबसे बड़ा जो टीचर है वो बुल मार्केट नहीं है। व्हेन वी आर राइट वी अर्न, व्हेन वी आर रॉन्ग वी लर्न। बेयर मार्केट में सबको मालूम पड़ जाता है कि भाई तुम्हारे में कितना दम है, या तुम कितने होशियार हो। वो जो मैं जो आता है ना, मैंने किया, मैंने कर लिया, मैंने बढ़ा दिया, मेरा ये बढ़ गया। तो मैं सबको एक ही बात बोलता हूँ, शेयर बाजार में तुम करते कुछ नहीं हो, होता है तुम्हारे साथ में। तुम अगर पिच पे टिके रहते हो तो हर तरह की बॉल आती है, तो उसको तुमने मार दिया तो तुमको पैसा मिल गया। अब हम लोग इतने सालों से हर साल थोड़ी पैसा कमाते हैं। मैं कभी ये CAGR VGR नहीं देखता हूँ, 15% CAGR, 25% CAGR, ये मेरे को समझ में नहीं आता है। मेरे ऐसे शेयर 3 साल 4 साल नहीं चले और बाद में चले तो 2 साल के अंदर में 10 गुना हो गए, तो मेरा CAGR अपने आप सुधर गया ना मेरे को। तो मेरे को ऐसा लगता है मेरे लिए काम कर रहा है। तो ये जो ये सब है कि CAGR देखना, ये करना, वो करना, वो यहाँ पे नहीं करना चाहिए। लॉन्ग टर्म विजन रखना चाहिए कि 10 साल में ये परिवर्तन होएगा कि नहीं, 10 साल में ये मैक्रो कैप जो या माइक्रो कैप जो है ये मिड कैप बनेगा कि नहीं बनेगा। अगर एक कंपनी 500 करोड़ की 5000 करोड़, 5000 वाली 50,000 करोड़ 10 साल में बनती है और आप उसमें 1%, आधा % कुछ भी शेयर्स आप उसमें लेते हो, चाहे जो भी आपके पास में जो वर्थ है, तो आपका पैसा 10-20 गुना 25 गुना ऐसे ही हो सकता है। तो राइट मोमेंट के लिए वेट करना चाहिए, राइट स्क्रिप्ट के लिए वेट करना चाहिए, हर बॉल पे मारने की ट्राई नहीं करना चाहिए।
विजय, हम अपने डिस्कशन के अंत में पहुंचे हैं, पर जाते जाते एक आपकी नई नज्म हो जाए।
अरे कोई नज्म नहीं है भैया मेरे पास, तुम फिल्म वाले उठा के ले जाएंगे मेरे को, क्या करेंगे यार। थैंक यू।
वो इतनी बुरी बात तो नहीं है वैसे।
नहीं, कुछ अभी दिमाग में नहीं आता है यार अभी।
अच्छा, तो दैट सॉन्ग फॉर इन्वेस्टर्स एक बार विद लिरिक्स।
मैं किसी को भी ना समझ में तो आए, तो बढ़ता बढ़ता क्यों गिर जाए, ये 90% लोग क्यों पैसे गवाए, जो सोचा समझा खूब समझ में ये आए, जो लेके गए बैठ वही तो है कमाए। आंखों को खोलो भैया, थोड़ा तो सोचो भैया, 10 में से 9 लोगों का खोता ट्रेडिंग में रुपया। लगता है सीधा साधा पर है ये भूल भुलैया, कोई भी बच ना पाया BA CA या MBA।
100%, as they say in emoji language. But Vijay Kedia, thank you so much for your time today. Always a pleasure. Thank you.
Thank you.
Thank you so much, Mr. Kedia, for sharing your words of wisdom with us. He said कि पिच पे डटे रहो, बुल मार्केट बेयर मार्केट कुछ नहीं होता, बस डटे रहो जो भी मार्केट सिचुएशन हो, ताकि अगला प्लेयर आके छक्का ना मार जाए। Now, before we move on to our next session, a sincere thank you to all our partners who made the ET Now Market Summit 2026 possible, co-powered by PhonePe, our mutual fund partner HSBC Mutual Fund, our associate partner LIC of India, and then of course feel free to share your thoughts about the evening, about our sessions on social media using the hashtag ETNow Market Summit 2026.
Right, and moving on now. For generations, Indians parked their money in fixed deposits, gold, and real estate and simply left it right there. You know, safe, familiar, and just rarely questioned, really.
Correct.
But that mindset is shifting fast, and how? And this even as a new wave of Indians learns to put their money to work. This conversation tracks precisely that journey from savers to strategic investors. So, steering this conversation forward will be Aisha again, back here on stage, even as her guest that joins us today is Kailash Kulkarni, Chief Executive Officer at HSBC Mutual Fund. Aisha, Kailash, we could have you back on stage, please.
And a huge round of applause for our next set of panelists. Ladies and gentlemen, again, another stellar fireside chat awaits us. Aisha, over to you. And also, please kindly settle down. It's going to be an interesting one.
Jude, once again. Well, I have with me Kailash Kulkarni from HSBC Mutual Fund, the CEO, to talk about today the shift in household wealth from savers to strategic investors. And, you know, that's one trend that we've seen play out, especially from the COVID lows. But Kailash, who better than you to actually throw light on that? Because, you know, wanted to understand, though, what do you think has led to this kind of evolution of the Indian investor from the 2020 lows up until now, from traditional saving instruments like, you know, FDs, did I say gold? Yes, I did say gold. And now to market investments. And the SIP flows that we're seeing are proof of that.
Well, thank you for having me on the chat. I think the answer is pretty obvious, but we don't like to call it out. I think the main answer to this is COVID. And we should really thank COVID. What COVID did was open the eyes of the clients to the liquidity factor. So you had a house, you couldn't sell it. Your business was shut. Some people didn't have money, there's no salary. You needed money. And they realized that liquidity is a cost. And India, you know, people used to buy 2 houses, 3 houses, you know, multiple things. So suddenly real estate, they realized it's not easy to unlock it as what was thought earlier because it was a buyer's market. So that changed the perception. Second, very important, technology. I think all these apps which are there in the market, the ease of which the integration has happened across onboarding to transaction, you can literally do it within 5 minutes. I think that's been a big change of behavior. So I think if you combine the two of factoring illiquidity, second, factoring the fact that you can actually make money because now historical data was there to show for 20 years that mutual funds have done well. Third, the mutual fund distributors have played a large part in terms of working towards a goal-based planning. And a lot of investors now work towards goal-based planning. So 10 years back, if these kind of markets were there, choppy, I can guarantee you the sell button would have been hit very often. But now they don't hit the sell button, they do consult. So I think these are the slight changes that have happened in the investor behavior. And you're right, it's really from 2021 onwards that you're seeing this very robust investor behavior that we have.
Had it not been for technology, you think this democratization of financial savings that one has seen at scale and at mass, that wouldn't have happened?
Yes, of course it is. But the reason why so many people shifted was the fact that they realized that when you need money, you need to factor in that liquidity. And today, we have lots of anecdotal examples, where clients said, I needed money and actually I could redeem my mutual fund unit. I couldn't even go to the bank to redeem my FD because my bank was 10 kilometers away and I had to take my FD certificate to the bank and it was not allowed, right? So I think those were the baby steps which kind of fueled the whole tech and the whole idea of why mutual funds should be looked at in a more positive light. Till then, it was more a short-term, thode paise bana lo kind of a game. But serious money started to coming in after that. And if you look at our SIP numbers, it's a testimony to that. Till 2020, what was the size of our SIP? And look at it after that. Yeah. It's just kind of a hit a J curve.
Having said that, given this market volatility that one has currently seen in the challenging times, do you ever wonder that the SIP investor, which has not seen a bear market, has been patient, yes, but it's only small ticket money that we've seen trickle in.
So,
since 2020, they've pretty much seen a one-way move up in the market. Do you worry that at some point they could redeem?
The answer to this is actually yes and no. So let me say why yes first, okay? It's the younger investor who is more adept at using the fintech apps to transact. And it's literally they order a Uber to go to a party, and while the Uber is coming, what do? They open their app and buy a mutual fund or sell a mutual fund. Or they say, oh, this new gizmo has come in the market, I need to buy it, they buy and sell it. I think it is those people who get shocked quickly when this volatility happens. So we haven't seen a bear market, but have we seen a scary market in the last 12 months? The answer is yes. A lot more calls have come to us. A lot more people are asking us questions. But that's what I'm saying. Earlier, people would just send the redemption to the office. Now they are asking questions. What should you do? And we can now, the beauty about tech is that you got data to show to every investor that, this happened in 2008, this happened in 2000, this happened in later on. And every time this has happened in COVID, the markets fell 30% plus within like 15 days. So you lost a lot of money. But when the recovery happens, all those units that you have accumulated at the lower end actually tend to go up. So I think data plays a very important part. And today with the infographics being made like this, little drop of a hat, anybody can put in a few lines and the artificial intelligence just gives you a beautiful infographic. I think it. No, I answered the yes. Let me tell you why I'm not so worried about it. Is because the investors are asking questions. I mean, we do have distributors in this room, and you can ask them. They aren't seeing too much redemption. Yes, the redemptions are there, but it's not peaked, despite 15 months not being very good. So they are patient, and we hope that gets rewarded in a short time to come.
Hope so. Since you are talking about data points, I do have one, and this is SEBI Investor Survey 2025 though, which is actually revealing a very striking gap. It says that 63% of households are aware of securities market products, but only 9.5% out of that 63% actively invest. Why do you think such a large gap?
So this is a 2025 survey, right, of SEBI. So 2025 is when the market's starting going extremely topsy-turvy.
Yeah.
So when a new investor wants to come into the market, he hesitates because he would have seen a 1.5% correction just the previous day. So he just wants to play it careful. So that's one reason. The second reason actually is a little funny, according to me. The new investors, and by the way, in 24-25, we added about 8 lakh new investors in the industry, first-time industry investors. So it's not a small number at all. And hopefully the markets recover quickly, like some of the other panelists were saying in a short time. You will see this number going to 1.5 crore for a year very easily. Okay, so the gap also is because I think as an industry where we have not done well, okay, is we are too technical in our conversations. Okay, we talk of ratios, we talk of short forms, we talk of terms used globally. The retail investor does not understand that. Okay? Again, we are a very English and to some extent Hindi. We are not Marathi, we are not Bengali, we are not Tamil, we are not Kannada, we are not Assamese, we are not Gorkha. We are not that in terms of communication. So, you wear a tie and a suit and you go to a Udupi joint. You do get some stares, right? Who's this person who's come to this Udupi joint? Well, it's like that. So if you're going to talk too technical, sometimes people believe that this product may not be for us. I don't understand this 3-year forward, 2-year, rolling returns, etc., etc. They want a simple thing. Is this giving me better than my FD returns? What kind of safety is there? And they want it in the local language. I think that's something we as an industry have not done very well. And that's one of the reasons this big gap exists.
Also, I wanted to talk about, urban participation stands at about 15%, while rural is just 6%. And we've had conversations earlier on ET Now, and we've talked about tier 2, tier 3 cities, beyond metros. When is it that you see active participation increase from those geographies?
So if you take the same number and do it on number of transactions, you'll have a very different statistics. Okay, today the number of SIPs which are coming in from the beyond 30 cities is outpacing the SIPs coming from the top 30 cities. Okay, the reason why we see this data is we are very AUM centric. I think as an industry, and I've said this 10, 12 years back, I requested the regulator, please stop ranking us on AUM and rank us on number of investors added to the industry. That's what is mutual fund all about. And you will actually see this change if you do it on a transaction basis, number of investors who have been added. And I just saw Karan sitting here. And if you ask Karan, he'll vouch this fact that 10 years back, all his clients were from the top 12 cities. Today you ask him, he'll say city number 30 to city number 100, I've got X number of clients.
It's difficult to get appointment with Karan in Mumbai.
But
keep it at that.
But he will agree to this fact. And that's the change which is happening in India. And obviously the people in Mumbai, Delhi, Bangalore are richer. So they put a bigger amount of money. The smaller city guys are transacting. So please do a program. I would say ET Now should take the lead of doing it, that how the smaller cities are outpacing the growth in terms of number of transactions and number of investors.
Absolutely, we will. And we will take you along with us to all the B30 cities. But I want to talk about, the SIPS flows. So far, they've been very, very consistent. You made a very interesting point that, people are not in a hurry to sell now. It's no more like an Amazon return. They want reasoning, they want questioning, they want to understand what's happening in the world right now. When you get panic calls from investors, what do you tell them about the state of the markets right now?
So like I said, are we communicating to the investor and showing him data? Because data is the truth, right? You can't fudge data. You're just showing him that yes, there are times when your SIP may not give returns for 15 months, 18 months. At times you'll have SIP returns which are negative. But one up cycle, all those negative SIPs suddenly become a plus 14 or plus 18% kind of a return because you've accumulated them at a lower NAV. I think we need to continue to talk to them and show this data on a more frequent basis because memory is short. And the other thing is that the younger investors, especially those who are under 30, they don't have the amount of patience to listen to us for half an hour. So you need to, unfortunately or fortunately,
do a reel.
Crunch,
then
yes,
you'll get
do
their
a
attention.
reel or crunch your conversation to under a minute and show them A, B, C, and they say, okay, I understand. Can you email it to me? And then they're willing to look at it.
Since you're talking about the younger investors, this growing conversation around over-financialization also at some level. Because the younger generation, the mindset is about instant gratification. They are the trade-in, trade-out mentality right now. That's the mindset that they come from. Do you think that also is a little risky at this juncture too? And we've seen the regulators take F&O trading and the curbs there so seriously.
Oh, it's extremely risky, and we've seen this in the digital currencies that people play around with, right? And now it's not so famous to do it because people have lost money in the last 1 year or so. So a lot of youngsters who were making money as the markets grew, or the digital currencies gave obscene returns, I would say, have actually lost 30, 40, 50% of their money in the current market. So that makes a big difference. So markets teach them a lesson that it's not easy to make money in this market. I think Vijay said that patience is, the most important thing in this market. You cannot think that you can make you double your money in 2 years. No, I think then you're in the wrong market. If you do it, you're lucky. Don't expect this to happen year on year on year. So I think it's very risky, but people will play. See, the younger generation like excitement in their life. Okay, so they would like to go into bungee jumping. Not too many people like bungee jumping, right? Especially if you're above 40. There are some people who do it, but if you're 30 and below, virtually everybody wants to go into a bungee, right? Now, why is that? Because the thrill and excitement. So I keep telling the younger set of people that, you know what, you should take out your money and keep a thrill and excitement kitty. And use that for thrill and excitement. Don't worry about it. Go to these exotic islands, party a lot, but also keep some money safe and the boring money, which will be there. You'll not look at it for 5 years, 10 years. But that's how life is. And I think if we do not listen to investor behavior, if you don't listen to how investor perceptions are changing, and just imagine I go to a young kid and tell him or her that, listen, you don't party for the next 10 years. When you're 40 years old, you'll be a very rich person. He'll throw me out of the window.
But definitely will.
Correct? So you need to have that entertainment kitty, excitement kitty, and enjoy life. So I don't see that to be, but that should be built as a part of your planning process, is where I'm coming from.
So given the demographic dividend, given that the average age in India is 28 years old now, in the next 10 years, where do you think household contribution to financial savings would stand at, and specifically to mutual funds?
Well, we were like low single digits in 21. We have now reached low double digits. So in 4 years, it's gone exponentially up. Can we see a 30%, 40% in the next 10 years? Why not? Because the engagement levels are improving between distribution partners and clients. Tech is enabling more people to come into our industry. Awareness is growing. I think Amphi is doing a phenomenal job in terms of sending the right messages. We started with mutual fund sahi hai, and now we are talking about patience because of volatility in the market, and you all have seen all those ads.
Yeah.
So I think the industry, I've never seen an industry so good, by the way. We have a unified KRA, we have a unified KYC. Onboarding is the fastest. If I as HSBC go and tell this anywhere in the world to the global partners, they are shocked. They actually say, you 50 AMCs have come together and any one client gets approved in any AMC, all 50 can sell because they are unified KYC. I said, yeah, and how long does it take? And they said it's like in minutes, and they just can't believe it. So India is at a different level, a different plane when it comes to being investor-centric. I think that's kudos to this industry. I don't think any other industry has done this in the financial services world. I'm not even talking non-financial services. So I see a lot of positivity. So I don't see any other reason why we should not have that.
Okay, on that note, and kudos to you as well for being part of the industry and so vocal and always calling a spade and advising the regulator as well on what really needs to be done to take the industry to the next level. Thank you so much for your time
I'm a
today.
super bull like Ridham was when he talked of equity markets. I think our industry, we will do exceedingly well. Thank you so much for having me.
Thank you so much for your time.
Kulkarni, for those wonderful insights, and I love the way in which you mentioned that, you know, consumers and audience want simplified solutions and nothing too complex, the way in which the industry tries to sell it to the consumer.
And the fact that data is to a large extent also helping a whole lot of investors really stay in and not exit. You know, like Mr. Kulkarni said, ask questions instead of simply stopping SIPs or redeeming a mutual fund.
Indeed, absolutely, Jude.
And in keeping with that theme of getting rich and wealth, really, the fact remains that even as we speak, India is minting wealth now faster than ever before, and the journey of creating it has changed completely. The old rules of safe, steady, and local simply no longer apply. Today, it's all about global diversification and understanding how the country's HNIs are investing at this juncture. Our conversation next will unpack that entire shift even as we talk about India's new wealth playbook. So spearheading this chat will be Aisha and Sajid, who will be back on stage with Karan Bhagat, founder, MD and CEO at 361.
A huge round of applause for our next set of panel. Aisha and Sajid, request you to join us on the stage.
Karan Bhagat, we never get to meet. So thank you for gracing us on ETNA's 17th birthday. What a year it's been, right?
Thank you. Thank you for having me here. And coincidentally, it's also 17 years for 361. So it's exactly,
Congratulations.
so it's exactly 17 years for both of us. We turn 18 this year, so it's been a long journey.
Wow.
But I can say that for ET and for ET now and for 361, journey's just about started.
Yeah. And we're neighbors.
And we're neighbors, absolutely.
What are the chances? But Karan, you know, not 17 years. For 17 years, you know, as they say, investing is all about patience. You know, the first question on my mind is, what are the kind of calls that you've got in the last 6 months from your investors? What's their mindset like?
I think overall, India's become substantially more patient in terms of volatility. I think capital is substantially more patient. One of the best things which is there in India is the leverage is still continues to be quite low. So people really don't have necessarily a large panic when there's a little bit of a drawdown. The other thing which is, I think, really worked well to everybody's advantage is the diversification of asset classes has been massive. I would today conjecture that not more than 50 to 60%, and in a lot of clients' cases, 40% of the money is in direct equity or long-only equity, either through mutual funds or through stocks. Nearly 20 to 30% has found its way into credit, fixed income, yielding assets like REITs and InvITs. Another 10-15% has found its way into gold, silver, and maybe potentially 5% in the odd international feeder funds. So portfolios are very well diversified. And honestly, if you've kind of maintained this portfolio diversification over the last 2 odd years, portfolios are still broadly in the region of 10, 11, 12%. So though equities broadly have ended up at 7, 8, most of the portfolios are quite close to the 10 to 12% mark.
And how do you see the diversification of investors as well? From the point of view earlier, you know, you have high net worth individuals coming in. Now you have family offices and other a sophisticated pool of investor coming in.
I think all three are different, right? I think if you look at retail investors, they are getting the diversification through multi-asset class funds. Okay, so I think you've got a lot of ideas, a lot of funds now which are able to take multi-asset classes. So I think the AUM of those funds have really grown over the last 12, 18, 24 months. For high net worth individuals, obviously, there are wealth managers like us who are able to work with them on a one-on-one basis to be able to diversify their AUM across multiple asset classes. And then finally, you have family offices. I think family offices are quite sophisticated. And more often than not, they've kind of broken their wealth into two parts. One is the safety pot, which is really kept in super safe instruments. And then after that, you largely have a growth portfolio, which is kind of engineered to grow at 12, 14, 16%. So I think that's the way the three have kind of broken up. And on the retail side, I think you'll see more and more money actually going into either solution-based products or multi-asset products as time goes by.
But is that the playbook, Karan, which is going to work in the next 1 to 2 years as well? You think multi-asset, multi-geography exposure?
So it's really tough to predict what's going to work in the next 1-2 years, but I always like to give this example, so I'm going to give it. It's a very interesting fact that, just let's take 12 years for an example. I think 12 years broadly speaking, I'm going to kind of approximate a few things. But broadly speaking, the volatility of a Government of India bond and volatility of the Indian index is broadly the same over a 12-year period. Over 1 year, obviously, it's very different. The volatility of the Indian index might be 13-14%. Bond will be substantially lower. So in a sense, risk is nothing but the ability to tolerate volatility. And theoretically, if all of us could be Rip Van Winkle and go to sleep for 12 years, there would be no reason to invest in fixed income because over 12 years, you're taking the same risk. Obviously, equities is broadly giving you 2 times that of fixed income. But reality is, all of us look at our portfolio every 3 months, 6 months, sometimes weekly, sometimes daily, and we're not able to really kind of digest the volatility. So I think next 1-2 years, honestly, there are a lot of variables in the world which are unknown. So I think volatility will be very high. And to digest the volatility, I think diversification is critical. So I think, honestly, 3 years from today, 5 years from today, we'll be in a good place. But we all have to not only believe in that, but we have to also experience that. Because when the drawdowns of the portfolio are large, we end up taking decisions which are not rational.
Have you seen drawdowns in the last 12 to 18 months? The kind of, we have seen geopolitical risk coming in, tariff, or whether it's a West Asia crisis. Are investors worried about it? Do they want to shift from risky assets to maybe more safer haven?
Investors broadly are quite smart. I don't see a crazy amount of panic, to be honest. I think domestic flows have been quite good. And obviously people like us, everybody here, the entire mutual fund industry, the regulators got a superb investor awareness budget. But if I look back and say, and we are sitting in 2026, it's an epic year because the first time I really got exposed to capital markets in some senses was 97, 98 when we had a similar currency crisis, right? We had the entire Asian currency crisis in 97. And I often think about this, but assume she was Nostradamus, okay? So and she had the
I wish.
and she had the ability to predict what's all going to happen in the world in the next 30 years. And she got it all right, okay, over the next 30 years. So she predicted the Asian currency crisis, the entire tech meltdown in 2001, the entire internet bubble, 2001 WTC attacks, 2003 Parliament attacks, 2008 global financial crisis. Fast forward 2021 to COVID, where maybe potentially 300, 400,000 people lost their lives. And most of us couldn't get out of home for nearly 18 to 24 months. And yet reality is, and I missed so many things in the middle, right? September 11th, 26 September, and so on and so forth. All of that has happened over the last 25, 30 years. And in spite, the world's obviously grown, close to 7 to 8% in dollars. India's grown close to 13 to 14% in rupees. And we all are in a phenomenally accelerated geometric and exponential point compared to where we were in 96, 97. So I think drawdowns will be there. Okay. I think the point I'm trying to make is volatility is the ability to bear risk in the time being, okay? Because eventually everything will be okay. So we have to build our portfolios in a way where each one of us is able to digest the ups and downs we will see. And that's really what our job is. We have to kind of ensure that the portfolio is diversified enough where you don't see large drawdowns.
But Karan, the debate is not about staying invested. I think that's a lesson every investor has learned. it's about the speed at which you need to juggle your portfolio that investors are grappling with right now. Be it geographies, be it quantums, be it asset classes. To that, what do you think should be the right strategy in the next 1 year? Because I know even 2 is a very long term, given the way the world is right now.
Actually, I would disagree with that a bit. I would say don't juggle it at all. Okay, so I think if you just go back again to my old example of 30 years back, I think in the order of what finally influences the outcome of a portfolio, I think 75 to 80% is asset allocation. Okay, so if you just go back 10, 15, 20, 30 years, the most important decision is how much you decided to invest in equity and how much you decided to invest in debt. I don't think so. The most important decision was which mutual fund did you buy, or did you buy the index? Yeah. So I think the fundamental thing is don't juggle your asset allocation much. And that's first thing obviously is decide your risk profile. Second, decide your asset allocation. If you're going to be 70% equities, 20% fixed income, 10% super safe debt, okay, that's 90% of the job done. The last 15%, I would say half is timing and half is instrument selection. Okay, so timing is okay. You kind of obviously look at price to book, price to earnings a little bit at the point of constructing the portfolio. And the last 7-8% is really going to be about about instrument selection. So if you honestly see, if you would have chosen the index, okay, over a bunch of 6 active funds, okay, the difference between the average of the 6 funds and the index, obviously the 6 active funds have done better. They've done 100 basis points, 150 basis points, or 200 basis points better than the index. But that's only 1.5-2% over a return of 12, 13, 14%. But your decision of how much to invest in equity and how much to invest in debt is the most important decision. So for me, honestly, if every person can build a small investment policy statement where they decide their risk-taking ability, they decide their asset allocation, and finally, I'm not saying don't optimize it, and then optimize your timing and instrument selection. But we should all be aware that 85% of the battle is already won in the first 2.
But, you know, I'll tell you where the place that I'm coming from. When you look at returns in markets like Korea, Taiwan, when you see the obscene amount of returns that an asset class like gold has given you in the last 1 year, then you wonder whether your asset allocation was right in the first place. You know what I'm saying?
I hear you, but see, we can't be slaves to today's return, because if you look at the return and measure it from today, last 1 year, last 18 months, last 24 months, and you really don't look at rolling returns for a long time period, you're you're like a slave to the value of that instrument today. Okay, so if you just look at the value of gold today and look at it for last 2, 3, 4 years, you're measuring it in a very tiny time period. Okay, so everything can look good and bad on a specific day, basis the way you're measuring it. But if you were to take a decision to change your asset allocation, I would strongly suggest you look at the rolling return data for that asset class, okay, over 1 year, 3 years, 5 years, 7 years, and then take a decision. And even then, and you kind of extend it to markets like Taiwan, Korea, and so on and so forth, okay, because it's impossible to get it right. It's, you know, just, and if any of us could get it right, anybody in this room, we would not be in this room, I can promise you. We would be somewhere in the Caribbean having a drink, so that's not going to happen.
Karan, you know, everyone knows that wealth creation is a long-term play which is there. But expectation of returns, has that changed in the last 2 decades?
For sure, expectation of returns have changed. I think we have to, honestly, we have to thank I think obviously number one, we've been in a country and we are blessed. Last 30 years, we've seen double-digit growth. Second, I think regulatory environment has been very, very conducive. And third, I think growth of the industry has been out of the box. So all 3 have kind of happened. But this has resulted in 2 or 3 things, and we are big beneficiaries of that in the business. I think one of the things which has really changed is, I think investor education has changed. Second and most important, people have kind of gone out of a shelf of having, you know, conventionally, if we met a client, let's say in 2019, 20, 21, the discussion used to be 50% in fixed income, 50% in equities. I think, I don't remember, I think it was 2022 or 23, when fixed income moved from a tax regime of 20% with indexation to being taxed as ordinary income. And that obviously made a big difference, because you're suddenly now on fixed income after paying tax, earning a return of whatever, 4.5%. So today clients are much more open to having their fixed portfolio in something called a safety pot. And for every person, that number is different. For somebody, it could be 5%, 10%, 15%. But it's no longer a percentage of the portfolio. It's a percentage of, it's like an absolute amount. The rest of the portfolio is really going into a growth portfolio or a portfolio which is engineered to grow at 12, 14%. And please remember, any return more than 16, 18% sustainably, not 16, 18 actually, let me correct myself, 12% post-tax sustainably can be only and only made in your own operating business, okay? Obviously, every person, if you look at most businesses in the country today, if you look at the top 500 companies, most of them would be generating an ROE, return on equity, of some number between 15 to 25%. Now, for that number of 15 to 25% to be generated post-tax, you have to put really a lot of hard work, a lot of labor, 24 hours of sleeplessness, dealing with all the production cycles in the factory, running around. So that return can only happen through your business. Obviously, for some people, very few select people, obviously India has seen the best. Mr. Rakesh Jhunjhunwala was among the best. For him, investing was his business. So he can hope to get a return of 18, 20, 24% on investment. But for all of us, where we are investing our surplus capital, okay, into investing, we have to have substantially modest targets of 10, 12, 14%. And, we have a term in our business. We say we are not wealth creators, okay? We are wealth optimizers. We are not just wealth preservators, okay? So no client comes to us and says, get me 6% return. So nobody's coming for a preservation. But at the same point of time, nobody can come to us for an 18 to 24% return, because that can only and only happen sustainably in your business. So we can optimize your wealth. We can't create wealth. So nobody can come to us with a crore and says, let's make it 100 crores. That's not really going to happen.
So are investors more risk friendly today compared to earlier? They're willing to take more risk, longer term risk?
No, as I said before, the answer is yes, because the safety portfolio is substantially smaller.
What are investors though saying about their equity portfolios in the last year and a half?
To be honest, equity portfolios have been very tough. It's not been easy because all the large cap stocks, a lot of the large cap stocks, especially in sectors which we fancied, right? So if you just go back maybe 15, 20 years and you look at, or maybe 25 years, and you look at banking and IT services, maybe it was less than 10% of the overall, 10% of the index weightage. Fast forward to today, your banking, financial services, and tech services would be close to half or slightly more than half of the index. And these two sectors by itself over the last 2.5, 3 years have hardly generated any returns. So very tough for individual investors to actually keep rotating sectors in that sense. Having said that, obviously over the last 18 months, you've seen the emergence of many new things. I think globally, if you just spread across, I think obviously pharma and healthcare have been very, 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 very exciting. Starting all the way from GLP drugs to all what is happening in pharma is super, super exciting. You've seen a lot of innovation on the AI side. You've seen a lot of, you haven't seen it yet, but you will. We end up meeting a lot of companies on the unlisted side, where there's huge amount of work happening on the AI applied side. So there's so many Indian companies which will come out and do a lot of work on the AI applied side. Hopefully even our tech services companies, IT services, will take a leaf walk and will kind of move towards the AI services side. A lot of work happening on defense. Okay, so if you see defense itself, I think there's so many good new Indian companies, right? And I'm really proud to say so many of them out of IITs and so on and so forth. We've got indigenous rockets. We've got companies which have kind of built the equivalent of Google Maps on space. We've got a company which is kind of doing multicolor imagery on in space. So a lot of work happening, I think, in defense and space. And lastly is energy, because all countries are obviously massively energy dependent. And I think right from storage of energy all the way to generation of energy, all the way to things which are kind of driving manufacturing towards energy will all play out. Valuations kind of move very fast, so they will move a little bit up and down. But I think the index is bound to change over a period of time, and it kind of changes every 20, 25 years. And that's the beauty of being able to invest in the index rather than being able to choose individual stocks.
How do you look at some of the emerging companies? Because you look at private space as well. So how do you look at those emerging companies? Because they may not be publicly listed today, but from a valuation point of view, how do you look at that?
So I think, to be honest, there was a point in time, 2009, maybe 19, 20, 21, and especially in consumer tech, valuations had kind of gone ahead of themselves on the unlisted side. But obviously, if you see for the last 4 to 5 years, valuations have been quite sensible. It's not as if valuations are absolutely out of whack. And, I think from a valuations perspective, if you look at first principles, okay, I think broadly, most businesses with consistent revenues get quoted somewhere between 4 to 7 times revenues, provided they can reach a stable state EBITDA between 15 to 20% at some point in time. They'll effectively quote at 20, 25 times EBITDA. So I don't see that being phenomenally different in a listed company and an unlisted company. Obviously, you have to wear a slightly more astute hat while looking at an unlisted company because some of these numbers are still not come. Okay, and some of the operating metrics in terms of the unit cost economics have not been defined yet. But the operating principles of how to value the business really don't change because it's listed or unlisted. I think pretty much remains the same.
Within the current pool of asset classes, Karan, available to Indian investors, what's looking like bubble territory and frothy from your end?
I think, to be honest, there are pockets of bubble and frothiness. I think if I look at all sectors, okay, I think there will be places, especially if you're investing overseas, I think there will be pockets of AI which might have run ahead of themselves. There might be other markets which have kind of factored in. I won't say they are frothy in that sense. They are frothy because they are factoring in years of growth put together. Okay, so if the years of growth come, then this frothiness will not look frothy. But even a small kind of prick in the balloon will kind of make it look very frothy. And to be fair, I think, honestly, I'm not finding the market phenomenally frothy. Okay, it doesn't mean there are no external global headwinds. Reality is we've suddenly seen the reverse of the interest rate cycle. You saw EU kind of raise rates by 0.25%. The 10-year GSEC in the US is 4.5, 4.6. All of these things from a macroeconomic perspective are not that easy to handle. So there will be shocks, but I don't see the market being superbly frothy. Even from a price to book perspective, we are not absolutely irrational.
From a company's valuation point of view, one of the arguments that always comes true is valuations are much more higher compared to average or compared to other emerging markets like Korea and Taiwan. When you look at investing in many of the companies or from the country point of view, how do you look at that?
No, valuation is a slave to growth. Okay, so valuation is nothing but discounted cash flows over the next 10 to 15 years divided by the effectively a discounting rate. Okay, so I think honestly valuations in India have continued to trade at much higher rates than what's been trading for global peers because our assumption, rightfully so, okay, for the last 15 years we've seen that our assumption for growth is substantially higher. Okay, so for example, if you look at a classic case of Indian private banks, okay, for the last 15-20 years when globally all banks have quoted at 1.5, 2 times price to book. Our banks have quoted at 3, 3.5, 4 times price to book. Because most banks globally in that time period were growing at 8, 10, 12%. We had our banks growing at 15, 20, 25%. Today, obviously, if the growth was to moderate down, okay, to 8, 10, 12%, we'll see the valuations also come down to 1.8 to 2.2 times price to book. So I think valuations in that sense, honestly, is a function of growth. As long as we believe, and it's something which India has delivered, that we can get a a nominal rate of growth of 10 to 12% every year. I think that should translate to an overall corporate India growth of 15 to 18%. There will be years like this year where you're seeing a lot of supply shock, right? Because we're getting a supply shock from obviously a little bit of the impact of the rupee dollar, a little bit of the impact of crude, plus you obviously got a huge amount of disruption in the supply chain. So I think there will be years where earnings growth moderate, potentially to 6 to 8% this year. But overall, I think we've consistently been able to grow at 12 to 15%.
But is the worst behind us for this year?
You're Nostradamus, you would know.
But Karan, we've seen the wealth industry grow many folds in the last 10 years. do you see this growth sustaining? Do you see more players coming in as more people create more wealth? They will need more instruments. They will need more avenues, and people like you to deploy that wealth.
No, for sure. Wealth management as an industry is going to grow across segments. Okay, so obviously, as a company, we've decided to be in a certain segment, but I think there's going to be growth across the board. Obviously, we have no way to estimate the exact numbers, but we would like to believe there are at least 25,000-30,000 families today with an investable financial assets of more than 10 to 15 crores. Okay, and obviously, if you kind of push that number to somewhere between, let's say, 5 to 25 crores, I'm just going to overlap some numbers. If you push it to, let's say, 3 to 20 crores, I think there's another 1.5 to 1.7 lakh individuals. And obviously, if you go below a crore, that number is, again, maybe another 50, 60, 70 lakh people. And this number is obviously growing at maybe 2 times the rate of growth of the broader economy. So no reason for me to even doubt for a second that this growth is going to continue. And it's going to continue across. Obviously, entities like ours have taken a decision to be slightly more on the north side in terms of size of clients. And hopefully, as time goes by, we can come a step lower and be able to catch these clients early as they are building out their journey of wealth creation.
So the equity markets are not wrong in the consensus trade on capital markets and giving the premium that they do to stocks from your industry now.
No, I think capital markets obviously has got huge amount of tailwinds in the country. I think we are blessed in a way where I think the regulatory tailwinds have also been very positive. I would specifically call out the alternative investment fund industry. I think SEBI has been very proactive in terms of regulations over the last 12, 18 months. You've also seen the kind of advent of SIFs, okay, which is kind of again fairly path breaking. So overall, actually, I feel quite comfortable. And plus, we've got a regulator where settlement risk is practically zero, because today you can come and settle as much amount of shares as you want on the exchange. You're really not concerned about the settlement on the other side. So I think overall we're in a good environment. And honestly, I think if I extend the entire thing to the unlisted market, today itself I would have met 4 companies, and yesterday another 4 companies, where the entrepreneurs are maybe not half my age, but maybe 75-80% my age, and they're doing some phenomenal work. And honestly, you fast forward it to 10-15 years, and I think a lot of these people will kind of end up creating first, obviously, adding huge value, disrupting the existing business models, hopefully helping in building productivity and adding to the country, and lastly, creating wealth for themselves.
Do you think there are enough disruptors in this country?
For sure, there are disruptors. There are, how do you define disruptors is also a question, okay? I like to define disruptors as inventors and innovators, okay? So it has to be both. We don't really have to kill ourselves always to invent, okay? We can always innovate. We should invent for sure, okay? And there's enough invention happening. But at the same point of time, being able to innovate on something, okay? So you can innovate on service. You can innovate on AI applications, okay? You can innovate on many things, okay? So I think it's a combination of both. And all of us have special skill sets. Me, for one, I'm not a great inventor, okay? But I would say I'm a good innovator, okay? So that's not a problem. There can be some bit of innovation, there can be some bit of invention. And I think both of that's happening in the country. See, we've innovated in our own way. So many different business models in the world, we've done it at the lowest cost, and that's because of innovation. So I think as a country, we'll continue to see maybe 70-80% innovation, 20-30% invention. We should not be shy about it. We should be proud about it.
What is the biggest...
Continue innovating is what I would say. Karan Bhagat, thank you so much for your time today.
Thank you.
Pleasure speaking with you. Thank you.
Well, if there's one line that truly stood out for me, especially, I beg your pardon, at this time of volatility, it's simply the fact that Mr. Bhagat said that diversification is truly the big key to investing in what is truly a volatile period for the markets. Also the reminder, a very friendly one at that most fund managers are not so much wealth creators as they are wealth optimizers. Absolutely. So optimization really is the name of that game. On that note, Mr. Bhagat, thank you so much for joining us and breaking down some of those insights on that very special chat.
Indeed, and now now we are heading into the last session for the evening, and let me tell you a very interesting one. Now, India's investor base has exploded over the last few years. India added approximately 16.3 million new demat accounts in the first 5 months of 2026 itself, pushing the total tally to 229 million by the end of May. But most of that growth has come in from the metros and the usual pockets of wealth. The next surge will look very different, coming from smaller towns, younger investors and first-timers, of course. Now, this panel asks where it begins, where we will get it. Now, the next 100 million investors, where will they come from? I would like to invite now ET Now's Harsh Satya and Snehi Shah to moderate the next discussion with our next set of panelists. Over to you, Harsh and Snehi. And also now we are joined in by A. Balasubramanian, MD and CEO, Aditya Birla Sun Life AMC, Nilesh Naik, Head Mutual Funds, PhonePe, and Sandeep Sikka. He's the MD and CEO of Nippon India Mutual Fund.
Well, as they always say, the last one's the best. So we'll hope and look forward to the fact that this will be perhaps one of the most insightful discussions that we have for the evening. On that note, give it a huge round for the next panel on ET Now Market Summit 2026.
And since we are also discussing where is the next bunch of investors coming from, the young amongst, the population of the country. So we have two very young and dynamic folks joining in from the ET Now team, Harsh and Snehi.
Thanks, Shibani. Thanks, Jude. No pressure at all, so thank you for that.
Good evening, everyone, and good evening to our very esteemed panel as well. Before we begin, this topic is so interesting. So before we begin, I'd like everyone in the audience to picture the one thing that comes to your mind when I say the word investing. Now, we're all thinking equity, stocks, money, return, more money, and that's what we're thinking when it comes to investing. But have you thought of people, of investors? And I'm not talking about the veteran names. I'm talking about a business owner in Guwahati, or a gig worker in Bangalore, or a recently graduated student in Lucknow, let's say, for example. I'm talking about that smaller cohort that is going to make up India's next 100 million in terms of investing. And why I'm talking about them is because the future of this industry is not going to be made by the people who are already investing in it, but it's going to be made by the people who are not yet looking at themselves as investors. So we're having this conversation to try and plug the gap between what takes a person from being a saver to an investor. And Harsh, it's going to be an interesting conversation at that.
Very interesting. In fact, the next 100 million investors are obviously not sitting in this room, but they're going to influence markets, right? So we'll try and get a sense as to how they will, and what better panel than this to kind of give us that spread as to what this is going to lead to. We have A. Bala, of course, needs no introduction, Managing Director and CEO of Aditya Birla Sun Life AMC. We have Nilesh Naik, he's Head Mutual Funds at PhonePe Wealth. Thank you. And we have Sandeep Sikka, ED and CEO, Nippon India Mutual Fund. Wonderful having all three of you. Let me first start off by asking you, how quickly can India get its next 10 crore or 100 million investors? Let's go around quickly, and if we can take a guess as to how quickly can we get there.
I think first I want to congratulate ET Now for the 17th anniversary, and I'll answer that question by saying, I think 17 years back the mutual fund industry size was less than 7 lakh crores, and today we are 80 lakh crores. And I can't make a guess, but I think before the next 17th anniversary, which is before 34th anniversary of yours, I think you'll see every Indian household will be a mutual fund investor, which means technically we would have crossed that number by then.
Wow. Okay. Nilesh.
Yeah, so, if you look at the last, let's say, 5-6 years, right, just talking about numbers, December 2019, we had roughly about 10 million unique investors in, let's say, mutual fund industry, right? Today, we are more than 60 million. So within a period of, say, 5 to 6 years, you have added those incremental 50 million customers. Now, to get to that 10 million, first 10 million, if you remember, the mutual fund industry, the first private player, I think, entered the industry way back in 1993. So it almost took quarter of a century to add the first crore. But within 5 to 6 years, you have added 5 crores, which means what you added in 25 years, you are adding almost every year, right? So I think even at that rate, forget about the compounding part, even at that rate, I would say 10 to 12 years, you will have additional, maybe 100 million investors.
Sounds conservative, Nilesh. Bala?
So I think we are always conservative in estimate. So I think what you just mentioned that, all of us have spent, me and Sandeep have spent more than 3 decades in the Indian mutual fund industry. As he rightly put it, Nilesh put it, first 10 years we have to do all the hard work. And if go and sell mutual fund is something that make investment. And then growth would have been very, very small and very slow. The next 5 years would have been much faster, the next 10 years would have been much faster. But the last 10 years, if you take from 2019 till date, you would have seen one of the fastest growing industry. And if you look at link that with if you put a graph in terms of awareness versus the growth, there is a simple graph you put, there is no such graph that exists. But today the awareness about investing in mutual fund is actually far higher than we would have probably had about 3 years back. Therefore, what Sandeep mentioned about Har Ghar, there has been SIP, this will probably become much easier in the next decade. Therefore, the end customer that we are talking about, the unique customers, will come faster than what you have seen in the last 4 or 5 years.
Right. Balas, let me ask you the next question. Where do you see the biggest cohort of investors coming in the next 5 to 10 years? And because we've seen so much geopolitical action already, while that is anybody's guess, let's say all of that subsides and we have a boring market for the next 5 to 10 years, so to say. Do you believe the next 100 million could come in that span? What happens if it's a lackluster market? Does that number go down?
Yeah. I think if you look at the general customer cohorts, if you look at it, there used to be a significant dominance coming from cities like Mumbai. The top 10 cities used to contribute almost about 90% of the AUM. And the rest of the market used to contribute only about 10%. When you say India, if you say Bharat, you cannot say that it is represented only about top 10 cities. And today the top 10 cities are now gone beyond, say, 100 cities in terms of awareness, wealth effect, and so on. The development that has happened in the last 10 years has actually increased the wealth effect I am talking about. It could come from multiple ways, whether income levels going up, awareness going up, self-employment going up, or maybe the asset value itself is rising quite significantly. And industries have got developed, gone beyond, so like Mumbai itself, with all the industries that used to exist in Mumbai, has gone out of Mumbai. I'm talking about some old mills are now become a residential building in Mumbai, but all of them actually have gone deeper parts of the country. Therefore, the development activities have got picked up across different parts of the country. Therefore, as we move forward, we'll probably see more and more participation coming from the deeper parts of the location. They are the ones who have not tested the mutual fund as much as it should have done. And given the fact that interest rates in India continues to remain very low, in the sense when I mean very low is something about anywhere between 5 to 7%. But ultimately, in order to create wealth, in order to create more participation, or maybe creating more pool of pie for one to meet the growing needs that everybody has got, the mutual fund will become actually one of the savings vehicle. Therefore, now we'll probably see the fastest growth. Even in the last few years, if you see, since the time the T15 became B15, then became T30 and B30, if you divide that into two parts, the rate of growth in T30 versus the rate of growth in B30, the B30 rate of growth has been higher than the T30 growth. And that, in my view, will continue as we move forward. And finally, one of the big area which I am quite passionate about is the spiritual tourism. I call it spiritual infrastructure. And it used to be earlier, there used to be only about 1 or 2 few locations in the country. And today, if you look at every state, have got tourism has become actually one of the big area of focus, which essentially means the income levels rising in each of these locations. Wealth effect keeps rising in these locations. Therefore, it will only keep spreading. I think what Har Ghar SIP, Har Ghar, where has to be an investment that Sandeep talked about, will become a reality.
That makes sense. Nilesh, let me come to you. You're now starting to get used to seeing investor journeys scale, right? It's not just about payments anymore. It's about getting penetration. what are the key barriers? Because barriers have changed. They've shifted. Now you do payments through a click of a button, investments through a click of a button. What's the key barrier that's stopping us from getting the next 10 crore investors?
No, I think firstly, it's already happening, but relatively speaking, if you think about, let's say, 5 years back versus now, people are a lot more comfortable, investing into products like mutual funds. But I think if you ask me about barrier, probably making that choice, right, of where to start, which product to start, is still a bit of a challenge. The other aspect, which I think the earlier speakers have also mentioned, which is a significant progress in terms of the KYC process. But I, for one, would believe that, there is still scope to, simplify it further. And a lot of people, fence-sitters who want to start investing, if we make that part, simpler, it just helps. And I think that is one of the contributing factors, in the last few years as well. With India's stack, the KYC, the Aadhaar, and even the payment part, happening so smoothly. That has been a big contributor, and I think that innovation will keep continuing. Apart from, the point I mentioned about helping customers to start with the, let's say, right product or a right set of products.
Sandeep, it seems like the markets may do well now that we've got some positive developments on the geopolitical front. SIP numbers have continued to look robust despite everything that's happening. Would you say the average investor is late to the party? Is that something you can conclude for people who've not made the most of this dip?
I think I would like to see it a little differently. I mean, I'd also like to touch on the earlier question. I think first, I think what's happening is, till now, while the mutual fund industry has touched 80 lakh crores, the reality is only 4 to 5% of India is investing in mutual funds. So to your question, late? No. I think we are not late. I mean, the Indians have just started investing in mutual funds. Again, a data point, what Bala mentioned about, 10 years back, Delhi, Mumbai were contributing about, the top 10 cities were contributing 72%. Today it's come to 50%. Today more investors are coming from small cities and towns. With technology, with a lot of things happening, I think today you'll see more and more investors coming into mutual fund industry.
Even commission structures are better? B30 plus and that helps?
I don't think so. I think it's not about commission structure anymore. I think what we have to understand is investment behavior is made over generations. Indians have been used to investing, and I think Indians confused savings and investments. Till 15 years back, 10 to 15 years back, when banks were giving double-digit returns, there was no motivation for anyone to go to capital markets. But today it's a new India. I think we see more investors coming from smaller cities and towns. It reminds me exactly last year, same time, we opened our first branch in Leh. And I think I compliment again because media has also played a big role in, popularizing mutual funds. And ET now covered that from all the way from Leh. And why I say this is, today the fact that I think your investors are coming from Leh, the armed forces, your cohorts question that you asked, it's no more about the cities. Now you have to see today, only 24% of women investors, and out of the total base we have, only 24% are women. But the reality is the AUM is 33% from them. There are a lot of cohorts, the new youngsters are coming in. I think today you have the PhonePe and other things that we are talking about. The technology is changing. Youngsters who are coming to the job market for the first time, they may not have money, but the first now the investment happens in a SIP. So it's a changing India. To your question, are we late? I think we are not late. I think you will see more and more Indians investing. And let's go back to your question of SIP. The latest data tells you monthly AUM, monthly inflow of SIPs is 30,000 crores, 31,000 crores. Let's convert that into, we are a population of 140 crore rupees. What we are investing effectively is less than 2,000 rupees per annum, per capita, per person. Now, if we say India will become a $10 trillion economy, the same investor will have more wealth to deploy. And forget, only 4% of the population is invested. So we are headed for great times in mutual fund industry, and mutual fund industry will fuel the Indian capital markets.
Excellent, and that makes a lot of sense. Nilesh, if I can come to you, what's the single biggest mistake that the first-time investor makes in his first year, in your opinion?
Yeah, I think one of the biggest mistake I think that people do is not having any plan. When in life generally, when we do even a small thing, traveling from, let's say, one place to another, you put a plan in place, right? I'm going to go by a cab or a car or, public transport or whatever. But when you invest, which is such an important decision in your life, right? People don't plan. And what they do is probably, look at a fund which has been recommended by, someone on social media, or you just look at one return number, 1 year, 3 year or something, and you end up investing into that product. I think that's the biggest mistake, I would say. And it's not just the starting product. It also has, influence on how the customer sort of, is retained in the industry, his second, third investment, because the initial experience is extremely important. And at least, we at PhonePe, for example, focus a lot in ensuring that the first product that we offer or the first few products are core products which can, give customers a really good experience, which is very, very critical.
Nilesh, just following up to that, UPI, the penetration has been wonderfully high in India. The adoption has been so good. Now, when I do a UPI transaction, I get to see the result in 2 seconds. I know my transaction has gone through as soon as I scan the QR code. On the flip side, when I'm investing in an SIP or in the equity market, it could take me months or years to know what the outcome of my decision is. So what I'm trying to say is UPI is a lot to do with instant gratification. Investment is delayed gratification. How do you bridge that gap? How do you make a product for users who are very used to instant gratification? And how do you try to make them play the longer game?
So I think, SIP has been a, great product, in terms of whatever success that we have seen, right? And by default, when you say SIP, it's a long term, right? So we have been focusing heavily on SIPs. In fact, today we are among the top 3 intermediaries in terms of the new SIPs that come in the industry. So first is that. Second is, in terms of your messaging, be it investor education, be it how you put it in your, journeys on the app. We talk about long term. You will always say that, okay, this product is meant for, let's say, 5 year plus. So the expectation is set upfront and people are not expecting, results immediately. And I think that is very, very important. Like you rightly said, a lot of people are used to buying, let's say, a t-shirt or a jeans on, some of the e-commerce, apps. But the moment you get the product, you realize whether it is good or bad. And today you can return it back, right? But in a mutual fund product or any investment product, you only get to know 3 years or 5 years later. And therefore, the first point that I mentioned, ensuring that right product is sold to the customer is extremely, extremely critical, from an overall perspective.
Bala, how do you ensure that? You've been in the mutual fund industry longer than I've been alive. How do you ensure that?
See, one should understand mutual fund is a boring vehicle. It's a pure boring vehicle. You keep investing. Sometimes returns comes extremely high. Sometimes returns will be very bad. But if you take the average return that you will get more than the nominal GDP. Therefore, I'm saying it's a boring. And second is, I think the mistake earlier we talked about, as long as people don't make the mistake of not investing first of all, that's another mistake. If you invest, if you expect instantaneous gratification, the mutual fund is not the place to come. So that the expectation setting is actually very, very important. If you set the expectation that I'm investing for a purpose, the purpose is actually a goal. Everybody has got a goal that I need to build my portfolio for long term for the following purposes. The purpose is known, you must pursue the goal. As we all do, it's mentioned about long years of career spent. What you have done, nothing else except pursuing your goal continuously. Nothing else. Whether it's Sandeep or myself, all of us, Nilesh, everybody would have pursued the goal and we play our role and continue to pursue the role and get better and better and not without looking for any instant gratification or even long-term gratification. Long-term gratification, instantly it comes to you because you've done all the hard work. Mutual fund vehicle also does exactly the same. If you stick to your asset allocation, stick to your regular investing and stay with conviction, optimism is actually has to be permanent, built in your DNA. If you do that, mutual fund will become boring, yet it will give you better outcome.
Right. Sandeep, quick follow-on on exactly this. Your thoughts, do you believe that in bull markets we tend to see one-time amounts go up SIP flows have been largely stable, but at least the one-time amounts have started to creep up in bull markets. 2024, Nilesh and me were speaking. We saw sharp spike up, but now in the bear market, when markets get you nervous, the one-time amounts come down sharply, even though SIPs have held up. Isn't that behaviorally anti-cyclical? Shouldn't amounts start to go up as markets come off, as markets get cheaper?
I take it the other way around. I think this is the biggest positive that has happened to the Indian markets has been investors investing systematically. In investment business, there should not be any bias. Actually, it's all about controlling your emotions. I think the point that you mentioned, why should anybody get carried away that markets are going down or markets are going up, start investing more or invest less? Actually, it's all about the discipline. Investing is a very boring game.
How do you repair that for the next 10 crore?
So it's changing. See, the fact that you mentioned, in spite of the volatile times, you are seeing the SIPs are holding, more investors are investing in SIP. And I think it's what happens is, ultimately it's all about education, which we have to do, which you have to do. SEBI data says, that I think 9 out of 10 people who are in FNO, they lose money. I mean, there is a thrill in doing it. Your question on instant, your instant returns, but 9 out of 10 are losing money. But out of all the investors who have invested in mutual fund industry, I may be off by data, but anyone who stayed in the industry for more than 7-8 years, he's never lost money. Let me give you another example that will, make the case even more exciting. One of the flagship funds of the industry, which is a growth fund which we run, has been there for 30 years. Today has grown by 400 times. The fund is 30 years old. In 30 years, today we have about 1 million plus investors, but there are only 2,000 investors who stayed the entire 30 years. Now, it's about, these are the people who did not get carried away with the market conditions. They were able to hold back their emotions. And that is what we want. If mutual fund industry has to do well, both the industry and media, we have to educate investors, don't get carried away with the market's ups and downs. Stay invested, stay long term. It's boring, but that's the only way to create wealth.
Kudos to those 2,000 people.
Really good, because I was just wondering, IPOs usually are a time when we see a lot of people enter the market if the speculation is rather high. And after that's done, book your profit or book your loss and leave. It's difficult to retain those 100 million that we're talking about getting. On that note, do you believe more people are not entering or staying in the market because they do not understand the market, or is it because they do not trust the market? And if you had to solve only one of these problems, which one would you look at solving?
I think it's not a question of trust for sure. Today, mutual fund is the most transparent product, is the most simple product. Rather, it's too simple. That's why people find it boring. And that is where I think the education, it's about understanding. And I think it's changing very fast. I think we talked about the numbers, you talked about the million of investors which have come. I think it took industry 50 years to be first 10 lakh crores. And the last 70 lakh crores has come in the last 10 years. So that's the pace of the industry. Today, the industry can proudly say, every district of India has a mutual fund investor. 99% pin codes of India have mutual fund investors. So it's no more a question of trust. I think it's a question of education. It's a question of inertia. And many times, investment behavior, like I mentioned, changes over generations. Many times it's a nudge. Nudge could be from a friend, could be from an advisor, or could be from media. So you have to also play your role to get your next 100 million investors.
And Bala, what's the risk that we don't educate them well we do a disservice to them, all of us sitting in this room? What's the risk of that, and how do we plug that risk?
I think the risk is one, expectation setting. Markets remain volatile. So therefore, you can never predict what will be the outcome in the short term. And educating investors at all point of time that don't get carried away by when the volatile time by moving out from the industry or moving up from investment or redeeming your investment, thinking that tomorrow the world will come to an end. At the same time, when you get extremely high return, don't get carried away that it also will become permanent. Both the things are not permanent. Then both are actually temporary. Therefore, from investor's point of view, are you looking on the basis of assumption that both will remain permanent, then will make the biggest mistakes. That's something that's what we keep advising and suggesting all the times. Stay invested in the long term, as Warren Buffett says. We keep saying the simple principle, as we say that don't forget the rule number 1. And second number is, so first rule number is don't lose money. And the rule number 2 is don't forget the rule number 1. So this is something should get imbibed and then keep the remember all the point of time. That's what we have to keep saying, that we are coming with some purpose. You are not coming for short-term speculation. You are not coming for quick money. You are coming for putting your hard-earned money for certain purpose that can serve your purpose in the long term. If that goal is there and the goal doesn't change, looking at the market fluctuations, the moment you start acting on the basis of what's coming in today's world, every day a narrative keeps changing, the morning and evening, depending upon which side of the bed you wake up. And if you start dancing to these kind of news, you will make the biggest mistake in your lifetime. Therefore, the mistake that one should never do is not listen to the noises and just stay with conviction and the boring subject, which is the investing for long term.
I'm going to add to the risk one more thing. I think what we were talking all this while, we talked all about equity. I think there's also very important risk. Today, there has to be right asset allocation. I think mutual fund industry is not only about equity. It's about fixed income. It's about commodities. And to create a portfolio in long-term wealth, it has to be a mix of everything. And what investors, the biggest mistake you can do is many times, because seeing the short-term return. So today, whether the last 3 years equities have done well, last 2 years gold has done well, the last year bond have done well, you start getting carried away. But the fact is, today the mutual fund industry can help you create wealth by having a very balanced portfolio. And we all need to talk about this a lot more. Equity is a very important part of the portfolio, but is not the only part. And to have a right portfolio, and the risk that you talk about is, if anybody is over-invested or under-invested in any asset class, that is the biggest risk.
And how do you fix that, Sandeep? Because that is the other piece I was just going to ask you about. Asset allocation, diversification, super important, not something that the first-time investor does. One of the possible errors that the first-time investor makes in his year one. How do you solve for that?
I think this will also be solved a lot with education and advisors playing a big role. I think it's not about just one portfolio. You have to see at the portfolio at the investor level. The real estate he's having, the bank deposit, because that is also fixed income, how much he's invested in equity overall. So it's going to be, it's not a one-size-fits-all. But broadly, it will be an advisory role more than a manufacturing role. But one thing is very clear. The multi-asset funds that we have now, I think that solves a part problem, but not the entire problem, because every investor has a different risk appetite. 5 of us sitting on the dais today, each one of us have a different risk appetite based on what stage, age, liabilities, and the future outlook we have.
Nilesh, on that note, what do you believe is the one product or the one service that the industry now needs? We've evolved over time. We've been an industry that's gone from ULIPs to now SIPs to you've got hybrids funds. You've got a lot of new things that are coming up. What do you think the next cohort of investors need for them to enter and positively stay in the market for the long term?
Yeah, I think more than the product itself, it's the way you position the product. I'll give you one example, right? We were looking at some data which is related to the working population in the country, right? And what we realize is this 6 out of 10, is a, what you say, micro entrepreneur, right? Is a self-employed individual. It could be a kirana shop or a vegetable vendor or whatever. So if 10 people are working in the country, 6 are self-employed individuals. And in fact, with that hypothesis, partnering with, various AMCs, we launched a daily SIP product. By the way, this product was launched long time back and didn't take off in a big way. But when we did this, I think 3-4 months back, the results were phenomenal. So the reason I'm saying this is because there's a section of potential investors who were not able to, invest because you didn't have that kind of feature in a product, right? So if someone has to invest 2,000, 3,000 rupees per month, for a self-employed individual, a kirana shop or a vegetable vendor, it becomes very difficult to take out those 2,000, 3,000 rupees on a single day. But if you tell him to invest 100 rupees per day or 50 rupees per day, it becomes very, very convenient. And we are surprised with the results that, with that, almost the numbers have gone like significantly higher when we talk about the new acquisition that happened.
And you sit at an interesting inflection point as well, Nilesh. You sit at the inflection point of the customer, the technology, which you have built, and you also sit at the inflection point of financial services and financial literacy. How do you get the right education to the customer? What's your sense?
Yeah, I think unfortunately, while maybe the intention is right, but when you talk about education today, right, if you ask anyone as to what is the education that you need or what is the advice that you need for picking a mutual fund, they'll say, okay, I will tell you which is the best fund. In fact, like, Karan mentioned earlier, picking a fund or a security is not as important as, how you manage your entire portfolio. And this is what, Sandeep also mentioned. So I think when it comes to education, I think it's important to have right kind of education and not just, the kind of education that you get on social media. So how do we ensure that customers listen to, educators who put out right information and not the top 5 funds of this year or the last 1 year? And I think that is very, very critical. The responsibility lies with everyone. And it's also about, I think, platforms which are getting these new customers. So if you look at, advice or incidental advice that you talk about, you take portfolio approach and the asset allocation approach rather than saying this is the best fund for you, right? I think all of this combined, can go a long way in helping us overcome that issue.
Absolutely. We're looking at adding more investors and perhaps not more speculators in that case. And to sum up this conversation, it's been such a wonderful one. Balaji, give us your thoughts, 2 cents on what you would like to say to investors, or rather potential investors who've started that journey from going to from becoming a saver to an investor. What would your advice be to them?
So my advice is very simple. If you're not invested, start investing. If I invested, don't get worried about market fluctuation and continue to invest. If you have more money to invest, add more money to invest. Keep in mind that you are investing not for short-term benefit, you are investing for long-term benefit or your own purpose. Therefore, look at the long-term investing and sign up as long as possible, either in the form of SIP, or think about investing your money that I'm investing for 10 years and forgetting about it. That's the only way you can create wealth. And it can help you meet your purpose. As simple as that.
So simple to say, so difficult to do. I think that concludes this session. Thank you so much, all 3 of you, for joining us.
Thank you, sir.
Thank you, audience. You'll have been a great audience. Thank you so much. Thank you, Bala, Nilesh, and Sandeep. Thank you so much.
Well, Mr. Balasubramaniam, Mr. Nilesh, and Mr. Sandeep, thank you so much for those insights. I think Mr. Balasubramaniam summed it up perfectly. Think big and think long.
Now, to bring the evening to a close, I would like to invite Aisha Faridi to the podium to deliver a vote of thanks. Aisha? Well, inviting Aisha Faridi to the stage. Aisha, you have to wrap up the evening.
Well, as we come to the close of the ET Now Market Summit 2026, I would like to take a moment to thank everyone who made this evening possible. First and foremost, our sincere gratitude to Mr. Tuhin Kanta Pandey, the chairman of SEBI, for setting the tone earlier this evening for the summit with his insights and navigating volatility in an increasingly complex global environment. His thoughts on market development, investor trust, and India's growth journey clearly gave us much to reflect upon. And a big thank you to all our speakers and panelists who join us through the evening today. We heard very diverse perspectives, healthy debate, and very practical insights as well from the growing role of domestic investors and the search for alpha to capital allocation, macroeconomic resilience, wealth creation, and the future of investing in India. And our special thanks to all our partners who helped make this summit possible, and to everyone in the audience, the investors, market participants, all the industry and financial community. Thank you for spending your evening with us and for the contribution to the conversations that truly matter. And finally, a special thank you to the entire ET Now team who's been working relentlessly behind the scenes. We hope you leave with fresh ideas, new perspective, and of course, a few questions to think about on the journey home as well. Thank you all of you once again.
Well, thank you, Aisha, and that brings us to the end of... Well, thank you again, Aisha, and with that, we've almost wrapped up ET Now Market Summit 2026, co-powered by PhonePe, mutual fund partner, HSBC Mutual Fund, associate partner, LIC of India. Now, Shibani, if there's one message that rang clear through the evening and through the noise and volatility, India's story stays as resilient ever and ever so full of opportunity.
Absolutely, Jude. Now, on behalf of ET Now, I'd like to thank all our distinguished speakers, partners, our audience for being a part of this insightful journey. Thank you all for joining us tonight, and we look forward to welcoming you again. Have a wonderful evening. Thanks again.